prosperous thoughts create prosperity in my life. My success is unlimited. My income is unlimited. I am worthy of success. I believe in myself. I am thankful for life. I am thankful for trading. I am thankful that I am a successful trader. I am a successful trader. I learn from my mistakes. I am always improving myself. As I improve myself, I become more successful. I know I can be successful. My beliefs create my reality. I see myself as a successful trader. I am relaxed. I am confident. I am disciplined. I am at peace. I let go of negative beliefs. I let go of bad habits. I do exactly what I need to do. I have everything I need to be successful. I deserve to be happy. I have everything I need. I respect myself. People believe in me. I believe in myself. I deserve to be successful. I trust myself. I trust my trading plan. I follow my trading plan without question. My trading plan protects me. The market cannot hurt me. Today I will take the right action. Today I will be successful. Today I will follow my rules. Today I will be a successful trader.
And now, for the thousands in attendance and the millions watching around the world, ladies and gentlemen, let's get ready to rumble!
Yes, sir! It's about that time. Thank you, and thank you for joining us live here today. This is Abdul Shabazz, and this is some real change stock options trading journey. And today, this wonderful Wednesday, Let's see what is going on. Where is the money? Let us talk about it. Let us find it. Let us create a plan to get it. Do what we do best. Thank you all for being in attendance. Thank you for your patience. We got about 19 minutes before we get this party started. Just enough time for me to create a plan. And that is exactly what I am doing right now, creating a plan. Yes, sir. Thank everybody for their patience and their attendance and for hitting the like button. If you already have a plan, feel free to put it in the chat. Let us know what you're thinking. Let us know what area you're looking at, what potential or possible trade you see. Grateful for any and everybody's input. Let me see, what do we have here? Beautiful control buying algo we identified yesterday. Okay, just about right. Bring it down just a little bit. Alrighty. Getting this plan together. Alrighty. That's right. Again, if you have plans, feel free to put them in the chat. Definitely thank you and welcome those plans. Alrighty, let me see what we have here. I'm getting ready to put my thinking cap on. Need to go ahead and think for a minute. Alrighty. See what the market is doing. Alrighty. Everything still seems to be all right. Let me look at the weekly. As today is Wednesday, let's see who's in control of the week. And it is the Bulls are in control of the week. Yes, they are. As they attempt to try to get back into this control buying algo and get back green for the year. Will that happen? I do not know. But now I see who has control of the week. Let me go ahead and look at yesterday. Yesterday we put in a nice doji. That's very good to see, and I'm glad I took the time to see it. So that's letting me know right off the bat as I look at yesterday's chart. Approximately where I want to do a little something here. 674.5. I'm liking that. Really 7. 674.7 on the entry. On a put entry. 674.7 on a put entry with a 676 strike. If that happens, we'll probably come down to 672.5. 672.5. First profit target. Second profit target. 669.5. Keep it simple. For a call. What do we need to do if we want to see a call jump off? Well, I'm still liking that 687 area where I first called for a profit target. We'll move that to the entry area. 680.7 I like for an entry off of a 678 potential call strike. First profit target 680. 682, 681.7 here. Okay, 681.7. And let's go ahead and change the date too. Why don't it's no longer Tuesday. It is Wednesday. How many people misspells Wednesday? All right, Wednesday 11. Got that. So move that 683. And second profit target is going to be 683.2. Got it. Bam. That's what my tentative plans are. Real quick, let's go ahead and finish mapping out. We're just strictly looking at the daily chart. I was able to come up with my plans just strictly looking at the daily candles, but now let's break it down even further as we do this top-down analysis. Started from the fact that we're in a red year, but then I'm looking at the weekly, then the daily. Aha, let's make it nice and big. Let's see what I got on my plans as I mark it up the charts, as I typically do. For that call, I set a 680.7 entry. Interesting. Okay, I like it. I said a 687. Okay, I like it. That we're talking this area right here. Go ahead and change the color. Let's talk about money. Let's talk about it. How to prepare and plan for it. That's what I would like to see if the market goes up. If the market decides to go up, then I'll take a call on that 680.7 area. Take that to that 681.9 area. I'm gonna say 8. And then 683.2 area. Nothing is exact. We're dealing with areas of probabilities. Our two key words are if and then. If the market does that, then I'll do this. If the market does this, then I'll do that. Very plain and simple. I want to look at the area I have for a put. Pulling that back up right now. I said 647.7. Where is that at? 647.7. Right here. I like it. I like it. Yeah. Try to grab it at the top of the algo. That's what we want to do. Get it at the top of the algo. Okay. Now let's see what that looks like now. Okay. Down to 669.5. Okay. What I got here? 672.5 first profit target. Off of 674, 676 strike, which is where we're at. Let's go ahead and pop that on the Heikinashis real quick so I can see the flow. Just want to see the flow right now. Let's see this flow. Okay. If the market does continue to come down and turn the 677 to a clear area of resistance, then I will look for that continuation. But again, I'm not going to get too excited because you see this very strong bullish action from the 699.3 area all the way up to yesterday's high of 683. So in order for me to be convinced, we will need to retrace, so much so that a lot of these bulls start feeling the pressure and start heading for the gate. Those are my plans there. Let's see what it looks like on the large chart. That's what it looks like. And for those of you who need to lose weight, head on over there to resetwithdrj.com. It's not another diet. You need to reset your metabolism. There are women that are losing, and men, 30, 40, 50 pounds naturally. No gimmicks, just pure, unadulterated reset of your metabolism. Faster, easier, better function of your liver. Man, more energy, clearer thinking. Just simply go and look at these testimonials. These testimonials are phenomenal. These testimonials alone say what I cannot say. Reset with drj.com. Thank you, Dr. J, for sponsoring. Oops, wrong one. Thank you, Dr. J, for sponsoring today's show. Unbelievable. Reset with Dr. J. If you tried everything else, now try the best thing out there right now to completely heal your body and lose the weight that you've been dying and trying so hard to do. But before you try another diet, you need to understand why you haven't been able to lose the weight. Reset with drj.com. Thank you again for sponsoring today's show. Alrighty. Now let's see what that looks like here on our larger chart. Those plans that I have, pulling them back up. 8 minutes before the bell kicks off. I said I like a 687 entry. Let's see what that is. Interesting. Yeah, I do. I really do. Yes, sir. Again, we had a nice pullback from that 683 down to the 677. And then we bounced back up to the 680.5 pre-market, putting in a lower high. Okay, so we have essentially a controlled selling algo happening right here with a lower high at 680.5 and then another lower high right here at 678. The reason that I don't want to get in above the 678 is because there is immediate resistance at 680. If we can get above that, then it will appear that the bears have given up hopes of bringing this market back down and that the bulls are starting to strengthen their resolve to take the market back up towards new highs. Granted, we're at 676 now, so that is quite a way from 676 all the way to 680. However, I'm looking for that easy money trade. I don't want to just hop in at 679 and then have to get right out at 680.6. I'd rather see this pop up to this 679 and give me another opportunity to potentially short it. So I am going to stick with that. With that 678 strike, 680.7 entry, and then 681.8 first profit target. Back again and try to touch yesterday 683.2. We did finally hit that. I got out on that 681 move. Did not get that extra profit. I will try to do better today. First profit target hit, but I didn't hold on for the second profit target. Nonetheless, we're on to today. Alarm set at 680.6. Want to see a break and retest of that area. And allow me to get in with that bullish momentum. Other than that, I'm not going to be fooled because the bulls have an uphill battle as two lower highs have already been established. A lot of resistance here at the 679 and then again at the matter of fact, let me go ahead and tweak that right now real quick right on time. Right here. Okay, bam. A lot of resistance here at the 679 and then more resistance at the 680. Once we get above those two resistance points, then it's a nice move for the bulls to go back and try to retest that 682 and 683. I'm holding with that. Alarm set, 680.6. That is my call look. Now, what am I thinking about for a put? 674.7. I like it. I like it a lot. I like it so much. We'll put that put alarm at 675. That will put us under yesterday's low. If we're able to get under yesterday's low, which is also today's pre-market low, let's go ahead and identify that as well. Bam. We get up underneath all of this. I'm looking for a put, and I'm loving it. So I'm loving that area for a put, but also want to keep in mind that I want to see a break and retest because the market has already bounced here once, bounced here twice, bounced here 3 times. But to me, that's knocking on the door, knocking on the door, knocking on the door to see if we can go any lower. If we do, first profit target I have is 672.4. I got 5. I like it, 672.5. Second profit target, I'm going to say 670. Make that adjustment. And there you have it. Alarm set at 675. Another alarm at 680.6. Staying out of the middle here. I'm staying out of this middle between my 2 alarms. Let me identify that with a box. Oh, God, that minutes back. Alrighty, that is the box that I want to stay out of. Don't want to do any trading in that area. Want to see what we do when we get to the top of it and when we get to the bottom of it. And again, that's exactly where my alarms are. 680.6 is the top of this box area that I have here, and the 675 is the bottom of it. Now, granted, that's a $5 range, about $4.50. But I'm not here to be tricked by the market. The key word for this year, we've been using it all year, is obvious trades. We want the obvious trades. We simply want the obvious trades. As we got 2 minutes before this bell cranks off, let's go ahead and get all the rest of the charts tuned in and tuned up. Beginning with that weekly that I was looking at on my trading view chart, showing that the bulls do have control of this week. The bulls, I repeat, do have control of this week for now. And you can still see that. Let me pull that up. Yesterday's action, and we had already shown you that that control selling algo, and boy, did we stay right in it yesterday. Right in that controlled selling algo, which is also key that if you look at that 686 area right here, let me get a line. That 686 area where I want to get in will be us breaking that algo and then looking for that. That is what we're looking for. Also, that 675 area, I want to get that right here at the top of the algo. Come back to it, and then bam. That is what I am looking for, and nothing else. Thank you for tuning in. Give me a couple minutes, and I will acknowledge everybody in the chat. I'm not real swift with those drawing tools. I'm kind of elementary with them. Let's talk about money. That's where I see the money going and continuing. If that should happen, you will find us ready and available. This is looking at the weekly chart. Yes, the bulls have control of the week, but overall, we are in a controlled selling algo. Keep that in mind as we are red for the year. Oh yeah, we are red for the year. But still a lot higher than we used to be. We have come a little higher than we normally have. can never count out those buy the dip bulls. Always looking for a great opportunity to get a great price. Because we know overall, don't get it twisted, overall we know the SPY goes up. But I'm so grateful that we have the knowledge to be able to read the signs when we should buy, when we should hold them, when we should get out of the way. Yesterday's action here on the daily chart, looking for a beautiful put below that 675, right off that daily. For those of you who are new joining us, especially those on Kick, first of all, I want to give you a special shout out and thank you. Top right chart is your daily chart. Right here in the bottom right next to me is the weekly chart. Right next to that, bottom middle, is the 30-minute chart. Bottom left is the 15-minute chart. Around here, we're going to look at this same instrument in several different glasses. Please believe that. And when I need to, I even pull out my special handy dandy "What in the world are you doing?" chart. Yes, sir. These are my magnifying glasses when I need to put it on you. What are you looking at? Show me what you're looking at. Bottom left is the 15-minute chart. I'm going to go with that view right there. That lovely view that also going to include yesterday's action. Top left is the 2-minute chart. Yes, it is. 2-minute chart. Coming out the gate. Whoa. Let's put that back. There we go. That's the like I look. And in the middle, of course, is the 5-minute chart. And we tend to blow that up sometimes. But before we make a move off that 5-minute chart, we want to look at the larger time frames. We don't want to go against the 30. We don't want to go against the daily unless you're doing a counter trend trade. But again, we just have some real aggressive overall sideways trend right now. And see, this box even extends towards yesterday. I love it. Give me above 680.6, you'll find me in a call. Give me below 675, you will find me in a put. It's just that simple. I'm off to the side, clearing up some of my other charts. Alrighty. I am ready to rock out. Big shooting star right out the gate. Big shooting star right out the gate. Bears already rejecting the 678, 4 and higher. The Bears have already established a line in the sand. Can't wait to get back to some of that level 2 action. You know, I love level 2. Nothing like pure price action. Jared Lewis is in the building. Nkosi's in the building. Dr. JB's in the building. Jesse Swanson is in the building. Big Ben is in the building. Nkosi's in the building. And special shout out to those of you who are kicking it with us on Kick. And we thank those of you who watch the replay, because we do appreciate the fact that you even take the time to look at the replay. Thank you. Yes, sir. Big Ben, I am thankful to be here as well. So grateful I have met you guys on this journey of ours, because we're all on an individual journey. We might be in different lanes, but we are definitely going in the same direction. Some of us a little more aggressive, some of us a little bit more reserved, but we all have the same goal in mind, and that is to change the dynamic of our family and contribute very strongly to those things and people that we love and find value in. And that is why we trade, to have an impact on our lives and those things that are near and dear to our hearts. But there's only two things you can really do with money. There's only two things that you can really do with it. And to me, one of the most important things is the second thing, and that is extend the good that you do beyond your reach. Let me say that again. There's only two things you can do with money. And the second thing, and to me is the most important, and that is extend the good that you do beyond your physical reach. You're able to bless somebody else and you don't even have to be there. Your money can reach places that you physically can't. Supporting those causes, supporting those people. Money is no good unless you can share it with someone or something. Alrighty. I've said enough so far this moment. Now it's time to let the charts talk. We got our plans, we have our areas. If anybody else sees anything, please feel free to put it in the chat. I am not a guru. I am not a guru. I am nothing but a student. I am a student, but I'm dedicated, I'm devoted, and I am determined to make multi millions of dollars trading the market, inshallah. There is no doubt about it. I am here to make millions. I'm not ashamed to say it, and I stand on it. I am here to make millions. And I understand that it is a process, and I'm willing to go through that process. Yes, sir. Thank you, Big Ben. I salute you, Ben, as well. And I salute the team for the consistency that you guys have shown as we show up and help and support, cheer, and support one another. We also call out our trades. We alert one another to anything that we might see that might pop up. And of course, with these uncertain times that we're in, we gotta have the news up with 47 in office. Man, boy, 47 is really having a time, buddy. But despite the world being in war right now, the market is trying to make a move higher. Unbelievable. Well, let's see what the experts have to say.
Advice to all these companies is this: you got to sell some stuff. You got to take all the money that you get from interest, and you got to give it to these people, and stop trying to close the redemptions. And if you have to, do what Blackstone did, do what Jonathan Gray did, because it was even better than how he saved BREIT, which, by the way, BREIT, his real estate investment trust, took in the most money, and it's just terrific. What he said was, okay, employees, our portfolio is good, and the employees kicked in. And Blackstone's the only way to be able to do this. Blue Owl did not do that. They did a kind of a creative way to get around redemptions, and that didn't work. You didn't want to do that.
Right.
Or you can be like Carlisle and barely do this stuff at all. But yes, it's everyone. It's not just, by the way, enterprise software. A lot of the stuff that's invaded this were companies that batched stuff and sold it on Amazon, which are, that's a second-rate piece of paper.
These aggregators.
The aggregators.
Yes.
How did they all buy the aggregators? They should buy my daughter's potato chip company. Hey, man, that's worth
She's good for it.
Well, I mean, they bought a lot of bad stuff, and somehow they felt if you bundle a lot of bad stuff together, a la what happened in 2008.
I was just going to say, sounds awfully familiar.
Yeah, let's put all these no-doc loans together from Arizona, and then we'll sell them, and we'll have Paulson short them, and he makes a lot of money, and ha-ha.
Jim, the other two big buckets of news today. One is Warsh going to Capitol Hill, going to meet with Tillis, who seems amenable to letting this process at Senate banking at least get underway.
Yeah, the senator who's my namesake, Senator Kramer, spelled with a C.
Yes.
Said, listen, this is going to be. He's a good guest this morning. He was saying he felt that I think the Democrats are going to vote for him too. I've studied Warsh. He's a heavyweight. He's a serious guy. I mean, he's not some guy that is just going. I know it's going to be tough because you have a president that will come in and say, look, you got to cut rates, but Warsh is his bias is to cut rates, but let's look at his CV.
Do you think, not to get into his head, but do you think at this moment even the president would say, okay, I get it if you don't want to cut right now?
Well, I think the president would say we're about to win the war, so why don't you get ahead of that? Remember, when the war is being, he's calling the game. I think the world thinks a win is the Strait of Hormuz.
Right. So there's Warsh on the Hill. The other is this Microsoft argument for a temporary restraining order against the Pentagon and this supply chain risk designation for Anthropic.
That Andrew Ross, that Sorkin was so right this morning, saying, wow, this is a big deal. They came out and they risk their reputation with the president because they feel like this is a very important issue, and he's dead right. He is dead right, Andrew Ross Sorkin, because you are risking a lot. Microsoft's stock has done poorly. I don't want to conflate. One's about free speech, but and you may disagree with them. Maybe you think that once you get the product and you give it to the Defense Department, it's theirs Department of War. It's theirs to do with what they want. I kind of agree with that. Don't sell it to them if you feel they're going to do what they want. But I do agree if you sell it to them, it's theirs. I mean, how are you going to tell them, listen, guys, we're selling it to you, but you got to do what we say? No.
Well, the flip side would be you have your contract canceled, and yet you still then can't do business with another vendor?
I think that's illegal.
That's what...
I think that's illegal.
Well, and there's a piece on Reuters today that some legal experts think Anthropic's got a pretty strong case.
I think they do. You can't, by fiat, break all contracts, and you take it to the Supreme Court. We know the Supreme Court feels. The Supreme Court doesn't like this stuff.
Right.
I think the Supreme Court, when you go look at that opinion by the Chief Justice, he actually lists all the things that happened and how erratic they were. And I thought that was important because he's basically saying in that little paragraph about how erratic they are, hey guys, and it was Linda Greenhouse who wrote the story.
The great Linda Greenhouse.
The emeritus, the best I've ever read in Supreme Court, saying, listen, you got to read this. This is really... So I went and read it. I was like, wow, he is no friend of the president when it comes to this stuff.
Right. Got a little activism news today in CarMax and Starboard.
Yeah, well, when you look at CarMax, you are kind of stunned at how bad they are. I mean, when you look at, let's compare them to, they want William Cobb on from H&R Block, used to be on the show a lot. Jeff Smith wants to be on the board, but gross margins for AutoNation to compare are 18%, and for CarMax they're 12.3%. AutoNation is making $17 per share, and CarMax is making $3.21. So I think there's room for improvement there in CarMax. It's not a good operator. It's not, and it should be. I know when I talked with them, I thought that they were going to go all AI and stuff. I mean, everyone says they're all AI. Have you ever met a company that doesn't say they're all AI? Campbell's. They got to get AI.
Yes.
They had AI to get rid of the cans.
Yes.
Well, they had tariff problems, too, with the cans.
Yeah.
I mean, that was
aluminum's a problem, Jim.
Yeah, that they may have to, there's a case, that's a case study. That someone's got to come in there radically change it. You know, they had Mark Klaus, who was in there, and he bought Rayos, which was a good buy.
Yes.
And then he went to the Commanders, and how ill-fated was that?
Oh, I think back to like Sarah Lee and things that they got rid of. Remember?
Oh, boy,
was that Godiva?
Sarah Lee used to be owned by Coach. There's a combo,
Yeah.
right? Pound cake and a Coach bag.
Yeah. Janice, did Nelson win this round?
Yeah, he won.
It's
Good
over.
for him. He won that one. Yeah, and hey, speaking of winning, Smucker.
Yes.
I mean, hey, Elliott's changes are great. I met with Mark Smucker, and I was saying, yeah, but the price of coffee, coffee's collapsed. And by the way, it's 10% of Starbucks, but you know, Starbucks is being left behind. I think that's a mistake. I mean, today it's over par 100. I do think that Starbucks is a huge winner in the collapse of coffee, and so is Smucker. And Smucker, Elliott's going to change that. It's very hard. I mean, like Elliott got in to Constellation Brands, and they couldn't change it. But then again, that's liquor and double.
Yeah, there's a lot of reporting this week on Starbucks in markets where Dutch Bros is starting to encroach, and what does happen to Starbucks traffic.
But I think Starbucks is going to try to go hit them where they ain't, so to speak. Going to go to a lot of cities or not. Where's the ring fence guy? You bring him?
The Morgan Stanley.
Going.
It was a question. It wasn't a declaration.
Right. I like Morgan Stanley. They're terrific. Ring fence. Don't use that term. Don't use super cycle and don't use ring fence. Don't use those terms.
Yes.
Say, hey, listen, it might be. Use that. It's got Claymore mines. You know.
Well, for now, Jim, we are kind of circulating around these levels just south of 6,800. Mixed markets with the S&P up a touch. We will get some bond auctions today. I think 10-year as we watch the 10-year. Get around 418 this morning in the wake of that CPI print, which, as we said, was in line. Yeah, closer to 4.2 this morning. And we'll watch for the impact on any rate-sensitive sectors like housing. We're back in a minute.
Very, very interesting to get today started. And this is with that sideways action that I was telling you guys about. Let me go ahead and pull it up and show it to you on this 2-minute chart here. And that's why I highlighted in that box. Let me back it up a little bit more. Here we go. We did get above it yesterday, but for the most part, we've been in this range. And so it is for that reason that I want to see us either break out of it or completely have another breakdown. But keep in mind, as I stated earlier in my analysis, that the market has knocked on the door 3 times in the 674.7 area. Here, bounced. Pre-market, bounced. And then later pre-market, another bounce at the same area. So we don't want to immediately short it when it comes to this area. We want us to show us for certain that it is thinking about heading down. And in doing so, taking back control of the week from the bulls right now who currently have it. Right here next to me, bottom right chart is the weekly chart, and the bulls do still have control of this week, which means you want to be careful because any downtrend action could simply just be a nice healthy pullback and a possible trap. So that's all I want to see is get below that 675, and I'm still holding on to those thoughts. Nothing has changed even with this first bit of market action, even though it is looking very, very lovely for no one right now. So let's just be patient. Over 6.5 hours of the day to find you a nice 5 to 10 to 15 to 30-minute move. No need to rush it. Enjoy it. Let the trade come to us. Again, keep in mind, and let's keep our eyes on these larger time frames as well. But it is starting to look a little bearish.
Staples, the biggest laggard on the indexes this morning. That's getting reflected in the Dow, with Procter the biggest laggard, down a couple percent. Some of the housing-related names, too. There's a look at Sherwin-Williams, Home Depot, with the 10-year at about a one-month high at 419. We will get Stop Trading with Jim in a minute.
Big shout out to everybody who is remaining patient right now. I was just saying the same thing, Big Ben. Yes, sir. Big shout out to everybody right now who is exemplifying patience. Patience pays. If you see something, let us know. We want to support you in that. Big shout out to everybody for being patient. Yes, patience pays. Thank you, Ben, for reminding us that patience pays.
It's time for Jim and Stop Trading.
One of my favorite companies is Cintas. They do a lot of small, medium-sized business, uniforms, facility services. And today, the stock shouldn't be down. Today, the company has reached an agreement to acquire UniFirst, which is a competitor. Now, under the Biden administration, the chance of this deal going through were slim to none. Under this administration, if a merger flew in the window, they'd sign it. So I think that, like a leaf, I think that this is one where it's going to be a really fundamental company that is in this industry that will, it's already pretty important, that will dominate millions of customers. It's a fantastic deal. I'm thrilled for them because I think that they will do better for their customers, actually, because Cintas is such a good operator. But, wow, I never thought this deal could get done. And this is the kind of thing that in the previous administration, but now it'll get through.
Yeah. When I think of small business exposed names, I always think of GoDaddy, which is not a good chart, and Paychex, which is not a good chart.
No, it's, Paychex people feel is going to be disintermediated by AI, and people feel GoDaddy is too. I mean, you got these situations where you can basically talk to the computer, and they do that. I don't like to bet against Walton.
Walton Goggins.
Yep.
Yes.
It's a great ad, but I do think that those are both, by the way, great companies. But I do think that people just say they're going to be disrupted more than it's usually you mention those two. They're the most. People feel they'll be the most disruptible companies. I don't know. I've had Paychex one many times. It's a very fine company, and I've used them. I've used GoDaddy, and it's a very fine company. And I think anyone who's used these knows that they're terrific. But I guess, Yeah,
We're in a period of disruption. There's no question.
I mean, Anthropic, the destroyer.
Right.
They could come on and they say, listen, we've got a plan for the Strait of Hormuz, and people say, okay, let's.
Dude, and Dario's on the cover of Time, the new cover that just came out. Yeah, yes, yeah.
How you like that?
How about
He's
tonight?
very funny, by the way.
Tonight?
The only Dario I knew was that the guy, the butcher in Italy. He used to come on like Top Chef. I've got Non-Crisis tonight.
Nice.
We want to see Mattel break out. He's done great things with the balance sheet, but it's Hasbro that has been the horse, not Mattel. Let's see what he can do about it.
Although Wells today reinstates overweight Mattel.
Yeah, that was good. Look, I think the stock's pretty cheap. Exciting day, but I'm not going to use the word again because it's like super cycle. And let's ban it.
Yes.
And I don't need. I'm sure that person's very nice.
We'll see it tonight. Mad Money, 6 p.m. Eastern Time, as we're flirting here with the flat line on the S&P 6780-ish. Don't go anywhere.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and Mike Santoli. We are live at Post 9 of the New York Stock Exchange. David Faber's off today. Coming up this hour, the head of the International Energy Agency, IEA, expected to deliver remarks in just a few moments. We'll be all over the wild volatility in oil with energy expert Paul Sankey, who says we're seeing a nightmare scenario play out. Plus, Council on Foreign Relations President Emeritus Richard Haass with us to talk about how the war could come to an end. And Oracle, a winner today. On strong earnings and guidance, we'll ask an analyst if this is the start of a bigger turnaround for that stock, which is surging more than 12%. But guys, we got the CPI report. And yes, this doesn't incorporate the war in Iran and the big spike in oil prices and gas prices, but I do think it's worth noting because we want to know what the underlying trend of inflation heading into this gas pump price spike. So I think the key is that the core overall CPI at 2.5% in February was good news. Why? Because it was a moderation. It was the lowest level we've seen year over year since 2021. That's good. Core, remember, strips out food and energy. It's kind of the underlying trend that the Fed watches. And there's the picture of basically where we've been, which is very high. There's the spike in 2022, 2023, and how we have come down to more normalized level. Are we at the Fed's 2% level? No. But we have come down, and that I think the 2.5%, this is the lowest pace in 5 years, is very good news. The overall metric increased 0.3% for the month, and it's 2.4% for the prior year. You had some big heavy weights in the categories that were better. For instance, used car prices, which always is a big weight. That was better. The goods prices, for all the talk about inflation and tariffs, goods prices barely rose. There was some tariff pass-through. I think you could see in apparel prices, for instance, appliances, furnishing prices, audio equipment had some weird spike, but overall goods prices were tame. Here's some of the parts that I picked up in terms of the biggest monthly increases from January to February. If you've been making salads, lettuce prices spiked, tomato prices spiked. That was the big 4% increase in fresh vegetables. There's the appliances and apparel that I mentioned, but overall, and then we can look on the flip side. It's some
By
of
the
the
way,
biggest
that apparel
detractors.
number is the biggest month-on-month increase in like 8 years.
Well, remember all those retailers that were telling us that we haven't seen the worst of the tariff pass-through on inflation? They hoarded all the inventories going into tariffs.
And Kosi, man, I'm glad you missed that, bro.
And they are starting to pass
I'm
it on.
glad
We
you
expected
missed
that
it.
the sort of worst hit of it in terms
That
of
was a
price
trap
increases
for
would be
real, for real.
around
If
now. But I
anything,
think
we
it's
should be
important
probably
to
getting in a
state
put
that
right now.
overall
The way
goods
those
prices,
Bears just got
they barely rose.
real aggressive with those Bulls, rejecting that 680 again and coming right to the top of that box. And that's why I said I don't even want to trade in that box. Anything in this box is a trap.
So, Mike, it doesn't.
Anything in this box is a trap. So I'm so grateful, and you'll never hear me say I'm so grateful you missed that trade, teammate. That's for real. Yes, sir. That ain't the one. That is not the one. That's a beautiful trap. That's all that was, is a beautiful trap. And we still in that range between that 680.6 and that 675. Again, we're looking for that safe, obvious trade. That was very, very tempting. And a lot of people just got their heads tore off trying to chase that call. Let us again continue to be patient. And I'm so grateful, buddy. So grateful. He said me too. Yes, sir. Very aggressive move, man, by the Bulls, and then an even more aggressive move by the Bears. Wow. What a day, huh?
Here on the extent to which it's going to be crude releases versus product releases, because that is going to impact how these markets trade looking forward. But WTI now here up some 2% as these 32 member countries announced the largest tapping of strategic reserves in history amid the disruptions in the Strait of Hormuz. Guys?
So, Pippa, just some context. That's about double what we got in 22. And you mentioned the flow. That's going to be an important number. But also mix is going to be important because some countries have crude to offer and some have refined.
That's right. So in Europe, it's primarily refined products, while in the U.S., it is essentially all actual oil. And what we're seeing here now is that it's not just oil. It is also very much a product story, given how much passes through the Strait of Hormuz and how key that area is for refining. And so the extent to which this trickles through to things like RBOB and diesel, both key, of course, for the economy, diesel known as the tax on the consumer, remains to be seen. Also, a lot of the diesel that's refined in the United States does come from those heavy distillate barrels out of Saudi Arabia. So we have to see what the mix breakdown is. And finally, just one thing to add, there is not an SPR equivalent for natural gas. So continue to watch TTF in Europe as well as in Asia, because Qatar's facility, Ras Laffan, being offline, that's 20%. And so that could be the longer term story here, even as oil prices come down a bit.
Pippa, just watching the market reaction to this, crude oil prices are up a few percentage points. Is it that it's not enough? It was baked in?
I think it was baked in to a certain extent, and of course, we did have about a $43 or so swing between Sunday night's high and then yesterday's low, and so clearly there are a lot of unknown factors here as well, and this was already baked in. And we are up about $15 or so now since the end of February, so that is a meaningful increase. But of course, we saw that wild volatility yesterday as well as Monday. And so as more trickles out in terms of what's actually happening in the Strait of Hormuz, no doubt we'll see more swings in oil prices today.
Great, Pippa. Thank you very much, Pippa Stevens. And just to check on gas prices, which this is how it trickles down to the consumer. Average gas price is around $3.48 a gallon. And we've noted the 20% increase since the war began and what that might mean. I just wanted to show you the long-term chart, though, to the context point, on gas prices. It's happened fast. It's painful. Yeah. You feel that, every day when you're driving. However, we're only at the highest level since, around 2023 or so. In 2022, we saw above $4 a gallon gasoline when we had that inflation spike remember when President Biden went out and tapped the SDR, the Strategic Petroleum Reserve, because he was worried about those high gas prices. We got through it last time without a recession, and maybe that's why the market is telling you, Mike, that we're not barreling into a recession. Yeah. We don't know how long this is going to last or how high it's going to go, but also, it can feel shocking because it's happened fast, but we have been here before.
Yeah, I don't think it's a matter of this is going to knock the economy into recession. It's just going to be a counter force to what we were expecting, which was consumer tailwinds. Sure. And I think the market is actually kind of telling you there's some hesitancy about how much we should bank on that at this point. In fact, let's bring in Chris Verone, Chief Market Strategist for Strategas Research Partners. Chris, good to see you.
Yeah, great to be here, Mike.
Let's just talk about what you think this market has digested, is in the process of figuring out. I mean, we all know you're supposed to buy the moment of maximum uncertainty. Yeah. Was that $120 crude, 35 VIX, or are we still figuring that out?
I think we're still figuring that out here. I'm just not convinced that Monday's open was the real flush internally, and I think two things can be true at the same time. You can be in a long-term uptrend, that is still our call, the 200 moving average upward sloping. At the same time, I don't think we saw that real good oversold condition develop earlier this week. On Monday morning, had about 40% of the S&P make a one-month low. Would like to see that more in the 60% category. I think right now about 40% of the index is above its 50-day moving average. Again, kind of want to see that lower to really mark some type of a flush. And then from there, you can say, okay, where are the oversold conditions in the uptrends? What can we lean into? I'm not sure we've seen that moment yet.
Just for context, we had a 5% pullback in the S&P in November, was it, at the low? We didn't really seem to have any kind of climactic flush there either, did we?
No, and really you have to go back to Liberation Day of 25, where you had something truly climactic. I mean, you were talking about, I wouldn't say generational oversold conditions, but certainly very deep oversold conditions. So it's been a while, but this has been a market that's kind of, as you certainly know, basically been range-bound since October, I think in search of a narrative. And that's why the relative strength is so important for us here. What from a leadership perspective is going to emerge out of this scrum? Because it's really been a scrum where the market's kind of been searching for some story or narrative of what will carry us the rest of the year. So watch the relative leadership. What emerges from this, I think, is going to be a very telling story into the back half of the year.
What are the clues right now in terms of what might do it?
Well, what I think is interesting, and we're always on guard for what is acting differently than our own intuition might suspect. And if you told me what was going to happen the last 2 weeks, I would have expected consumer staples to be one of the top performing groups, and actually it hasn't been the case here at all. Frankly, discretionary's traded better than staples over the last 2 weeks. So I think this idea that all defensives are created equal is probably wrong. Healthcare looks a lot better than staples. Youths look a lot better than staples. I also think there's a misnomer that energy suddenly got good. I mean, energy, got good in our work, I think last September is when it turned positive. European energy turned positive last summer. So this has been a long time building in the kind of crude markets. And if you got some sell the news in the energy stocks, if you want to sell me yours, I'll take them off your hand, because I do think we're in some longer term relative uptrend in the energy sector here.
The other question is tech, right? As a leadership group, it has led month to date information technology, as a lot of these beaten down names on the AI disruption trade have come back, like a CrowdStrike, Datadog, But that, I do think, is one of the questions, because can the market work without those kind of names?
Yeah, I think these are pretty reflexive rallies in what are very weak long-term trends. Like another example of where the weakness didn't suddenly emerge in software in January and February. I mean, these have been weak on a relative basis going back to last summer. You got very widespread oversold conditions about 2 weeks ago in software. I'm not shocked to see it bounce here. I wouldn't stand in front of it, but don't overstay your welcome. These are still some of the long-term downtrends. What I do think is interesting is, this narrative emerged about the same time between the private credit stocks and software. Interesting to me, like Apollo has not made new lows here over the last couple of weeks. I mean, you go back and look at the long-term chart, it's kind of where it should bottom if it's going to bottom in this neighborhood. So if we're going to get past the Iran stuff, we also have to look to, well, do we get past the private credit and the banking issues? And, watching these private capital stocks, if they can act better amid just widespread pessimism, I think would be a pretty important indication.
Owl's the exception on that. I mean, it couldn't hold 10. Now it can't hold 920.
Yeah. Owl's making new lows. The others have not. Owl has very high short interest. I think about 15% of the float is short. So I would be careful on the short side in some of these names. The harder question is how much leash do we want to give the bank stocks here? They've largely been immune for, let's say, the past 18 months to some of these issues. The last 2 or 3 weeks have looked differently. How much leash do we want to give them here?
Yeah, big question. Chris, really appreciate it.
Thank you.
Thank you.
Here's our roadmap for you for the rest of the hour. When we come back, oil expert Paul Sankey joins us to weigh in on the IEA's decision to release 400 million barrels of oil from its strategic reserves. New this hour.
Plus, Oracle shares jumping this morning, gaining back ground after a brutal start to the year. We'll ask an analyst if this is just the start of a bigger comeback.
And as we just mentioned, some fresh concerns around private credit this morning, this time surrounding JPM, this piece in the FT. We'll talk more about that as those shares are down just slightly when Squawk on the Street continues.
Yeah. Welcome back. You have the Dow's down slightly, the S&P 500 up about 1/6 of 1%. We did get a little bit of a of a bounce attempt after we got that announcement that the IEA nations are going to be releasing $400 million barrels of energy supplies. Crude's still up about 3%. This was a pretty widely handicapped potential move that we were waiting for coming into the day. S&P still trying to hold up, though, above those recent lows that we hit the really overnight Sunday into Monday, and figure out if that was sort of enough punishment here. There also were some headlines out of Axios, president saying there's not much left to bomb in Iran. Who knows if that was also taken as another one of these signals that people don't want everybody to get too far down the line of thinking that this is very open-ended.
Yeah, I mean, he continues to suggest or say outright we're closer to the end than the beginning here when it comes to the work being done on the ground. It's technology, really, and that's been the leader, and that's what's led us out of a few of these big sell-offs on oil. And it's been a different flavor every day. Today, it's Tesla actually working well.
Tesla's moving. It's got that kind of Uber self-driving news there. Of course, Oracle is leading on its results.
Yep, that helps.
And what's really been interesting
Intel.
is this month, so basically since the attacks on Iran started, you had a real reversal in the dominant trends that started the year, which was non-U.S. stocks beating U.S. stocks, which was equal weight S&P, the average stock beating big tech. That is actually reversed. So you've seen some of those extremes come back together. Even semis versus software have converged a little bit. So you almost wonder if the market's kind of rebalanced itself. Some of the more extended parts of the market, like the Korea stock market, have actually had bigger pullbacks and resetting the market's footing to wait to see if it has clearance on the news front to make some progress.
Dollar up every day. That's another big reversal.
Meantime, breaking news a few moments ago, as Mike said, the IEA are going to release an historic stockpile to bring down or try to bring down crude. The release of 400 million barrels is more than double the agency's biggest prior release in 22. Let's bring in Sankey Research President Paul Sankey and get some reaction here, Paul, because aside from the number itself, not a lot of information or detail on how this is going to get implemented.
Yeah, that's right. And I think, we're not seeing a huge reaction in oil markets, which obviously is a concern. That is to say, you would expect oil prices to drop on the news. You mentioned earlier that it has been telegraphed that this will happen, but it's not dropping oil prices in the way you might hope, given the scale of the seeing here.
So what variables are you watching right now to determine where prices may go?
Well, obviously, it's all about the Strait and, how we can somehow get this thing open. That's what we've said all along from the beginning of the crisis. It's absolutely vital that this control is taken back over the Strait, and it's going very badly, as you know. We're just simply not getting this open. As you know, there's a couple of outlets for crude that have come through from the Saudis' West-East pipeline, and Abu Dhabi can get around the Straits. But the only oil coming out, basically, is coming out from Iran to China. And the ongoing situation, as you know, isn't that there's any kind of clear path towards the Straits reopening. In fact, we seem to be heading in the opposite direction. You mentioned tech earlier, and, we're very concerned about Taiwan, particularly, obviously, because of its importance to chips. You've got to remember here, it's not just about oil. You've also got the concern that we have about helium, which is vital for Taiwan's chip industry. You've got major issues with sulfur, with fertilizer, the list goes on. So it's an extremely concerning situation and continues to be.
Right. Yeah, we mentioned some of those other commodities you talked about. It is planting season. A lot of angst from the farmers here in this country about the price of fertilizer, nitrogen. Do you think food is going to be an issue in the coming weeks or months?
Well, again, as you know, the sheer scale of what passes through the Straits and has passed uninterrupted through the Straits for the last 50 years or more is just enormous, and there's never been this kind of a disruption in any way. We've never lost a day, let alone, coming on nearly 2 weeks now. And, as a result, you're going to see some really heavy knock-on effects. Frankly, I think some of us are looking at this a bit like what we saw with COVID, where the market seemed to be airwalking, regardless of what was clearly a very bad situation. And then suddenly, collapsed when it all came home. And that's obviously an exponential effect for how long the outage continues. One day wouldn't have been a big deal. 1 week, probably okay. Once you get to 2, 3, 4 weeks, then we really have a global problem in a very big way.
Yeah, Paul, I guess that was going to be my question, how loudly the clock is ticking here. Because if I look at, you look at crude prices, whether Brent or WTI, they're right in the middle of the range for this crazy move. So what does $90 Brent right now imply about how long we're going to have these disruptions, given that, of course, the forward curve continues to show much lower prices?
Yeah, I think there's a couple of things there. Number one is that you obviously worry about the demand side of the equation. So you can correct the situation by ending demand, as such. And there's actual real shortages in Asia, which means that in some ways the market's not really reflecting supply and demand. It's simply suspended at the moment. But as you're right, the price hasn't been as high as you might have feared. If you'd explained, if you'd told me 3 weeks ago we're going to shut the Straits of Hormuz for 2 weeks, I would have thought you would have sustained above 100. Of course, there are some short-term offsetting impacts, but in many ways you can look at an emergency stock release as bullish. It's not really a great word to use here because this is a negative situation, but the fact that we're not coming down a lot in oil as a result of the release is obviously concerning. So, I think that we've just got to sort of find a way forward here to get these tankers moving again, because absent that, the situation is just going to continue deteriorating, in my opinion.
Although positive that we're off the, highs of 120 or 119 or so, where we were, in sort of peak fears around all this, Paul. What other options does the president have at his disposal if he were to want to continue to fight this? I mean, obviously, it seems like a political liability as well going into the midterms to have high gas prices. And now that we have so much oil production in the U.S., there's talk of waiving the Jones Act, for instance, which requires, U.S. goods to be shipped between U.S. ports and moved on U.S.-built ships. Maybe that would provide some leniency. I don't know, other rules or temporary guidelines he could put on oil production that would help?
Yeah, I mean, I think, as you know, there's a couple of things. Firstly, that when we went into the Russia-Ukraine situation, we were already in a European gas crisis, and so markets went absolutely crazy. The thing about the Russia crisis was we didn't have a significant outage, actually, from Russia. You had to reset the trade flows and go shadow and everything else they did, but the actual volumes lost in total were very limited. In this instance, as you know, you have a major loss. The president has a number of things going in his favor here. Number one is obviously that the U.S. is a major oil and gas exporter now, and so we're less directly affected. I think the Jones Act is really a third rail in Washington. It'll be hard to take that off, but you could put a ban on exports. I really hope he doesn't, but you could put a ban on, say, for example, gasoline exports if you want to get from the U.S., if you want to get the gasoline price here in Europe, in the U.S. down fast. So there's a couple of other direct market interventions that you can make. And then in Asia, what you're seeing in Korea and Taiwan is price controls, and rationing, actually. So that's also a contributing factor, as I said, to the way that oil prices are not going up as much as you might thought, that countries are already aggressively responding in order not to just spiral the high price higher and higher.
Yeah, we had a discussion this morning about some of the boomerang effects if you do become an unreliable supplier of exported fuel, what might come around the bend in response. But that maybe, hopefully, is a story, hopefully not a story at all, but maybe a story for another day, Paul. Appreciate it very much. Good to talk. Paul Sankey.
Thanks, Lou. Thanks.
Still to come, Council on Foreign Relations President Emeritus Richard Haass on his take on how the Iran war could end. Plus, the latest domino to fall in private credit as one big bank moves to rein in lending and mark down software portfolios. But first, Oracle shares popping here in early trade. We'll talk to an analyst who just raised his price target on the stock post earnings. We'll be right back.
It's about to go down. I'm in a put, team. I'm in the put.
Oracle's leading the S&P this morning
put.
after results that did beat on the top and the bottom lines, and they boost their guidance for 27. Let's bring in Tyler Radke, co-head of U.S. software equity research over at Citi. Talk about this print, Tyler, which I guess some are impressed and arguing that they probably didn't even need to raise their revenue guidance, but it's nice that they did.
Yeah, absolutely. And I'd say what a difference from last quarter. Not only, I think, did this quarter show pretty incredible execution, standing up 400 megawatts of capacity despite all the data center delay and cancellation headlines, but it was a pretty clean beat both on the top and bottom line. Q4 guidance was strong, and importantly, the bookings that they undertook this quarter, they said that these new commitments didn't actually require any new financing. So customers are either prepaying, bringing their own hardware.
Jody.
So I think it checked the box on both execution.
I'm in this trade,
data centers
and I'm
are
winning.
coming online, maybe even faster than expected. They're pursuing, more creative, more financing-friendly strategies to get the capital, and also doing so profitably. Our numbers went higher both on revenue and EPS following the quarter.
What about the classic complaints
I know there's going to be a
about
potential
CapEx
bounce
to
here,
revenue,
as I
cash
expected
flow?
it.
Can those
So
be
I will
lived
be
with now?
taking my first profit.
Well, I think it helps, right? I think the concern is when you're borrowing money to spend on CapEx and then there's more uncertainty in terms of that capacity getting stood up. That's when you start to really see the concerns show up in the market. So by showing that they're delivering on or ahead of schedule, and that the margins are coming through, I think that helps alleviate some of the concerns. And again, they're taking on some maybe more creative financing structures, either customers prepaying a little bit more upfront, or bringing their hardware. So I think it's a pretty good read through on the broader space. You see a lot of the peers and hyperscalers up in sympathy. So I do think that this helps alleviate some of the broader concerns on the AI trade.
Tyler, you mentioned the differences between now and the prior quarter. To me, the main difference is the stock was at 221 before the last print in December. It was at 150 before this one. Clearly a lower bar. Where do you think the value can get back to, assuming Oracle continues to deliver as they promise?
Yeah, no, you're absolutely right. And granted, software and large cap tech has sold off pretty broadly since December. It's been a rough start to the year. So they're not the only one that's been hit. But look, our target price went up to 320. How do we get there? We're looking at their FY29 EPS. We're actually putting kind of a market multiple, a low 20s earnings multiple on that, discounting it back to get to today. So that's still quite a bit of upside, almost 100% upside. And again, that's where the stock was in the fall. So I think they get there. It definitely requires execution.
Go ahead, cut that away from my 675. I expected that bounce there.
They keep stringing together
bounced
these quarters.
twice.
They
Just wanted
bring
to
on
see
the
if I could get in
capacity.
just a
They're
little bit
able to,
early.
Manage the costs and show this
No harm, no
acceleration
foul loss,
in
nothing
revenue
on that
and
trade.
earnings. We're projecting Oracle is going to grow
Back to
revenue
remaining
and
patient.
EPS, between 30 to 40% over the next 4 years, which would make it one of the fastest growers in the S&P 500.
What's the deal with Project Stargate? I know that
beautiful
Oracle's
green
pushed back
hammer
against
at the
some of
bottom. What a
media
beautiful
reports
bounce.
about
This is
idling,
getting ready to turn out to be a
that's an
beautiful
important
call.
driver for growth
It's on the
for Oracle, isn't
horizon.
it?
So glad.
Yeah,
I didn't hold
look,
on to that.
I think, as you heard on the call
Remaining
last night,
more and more
I don't even know
patient.
if they mentioned
5
the
just
word
crossed below
Stargate.
20.
So there is, I would say, still a little bit of uncertainty and, conflicting press reports out there in terms of this capacity. But I think, what do we know? This supply-demand imbalance continues to get greater, right? So
come on
whether it's
down, baby. Come
OpenAI,
on
whether
down.
it's Meta, whether it's Anthropic, whether it's another hyperscaler, as soon as capacity comes online, it is
My damn chart has frozen. My chart is stuck. My chart has frozen. I apologize. See if we gain back. My chart has frozen. My damn chart has frozen. My chart has frozen. I don't know what's going on. My chart is frozen. It's stuck on 1035. My chart has frozen. I don't know. Yeah, I'm just go ahead and reboot it. That's all I can do right now. And we are back. Once again, highlighting this no trade area that I identified in this box. Waiting to see if we get a breakout or break down, but stay out of the middle. We talked about the market finding support here at the 675. It's done it 1, 2, 3, and this is the 4th time it has found support at the 675.
Welcome back. Markets remain on edge as the war in Iran intensifies. The IEA just announcing last hour historic oil reserve release. And overnight, the U.S. said it sunk a number of Iranian ships, including mine-laying vessels near the Strait of Hormuz. Yesterday, we spoke with U.S. Special Envoy for Peace Mission, Steve Witkoff, and I asked him about some of the criticism, the naysayers, regarding the urgency to launch a war to prevent Iran from having nuclear weapons. Listen to what he said.
They had 460 kilograms of 60% enriched material. There is no reason to be at 60%, none, zero reason, unless you're pursuing a weapon. So that's the first thing I would say to the naysayers. The second thing I would say to the naysayers is, who actually shows evidence of their weapon? Would a murderer do such a thing? Everybody has known that they have been testing for weaponization since 2003. The IAEA has attested to that. So we know that they've done all kinds of testing on weapons. And it wouldn't be all that much for them to do a World War II vintage type weapon. So we knew that it was possible that they could have a weapon, or they might be close to being able to procure a weapon. And then I give you this other detail that no one seems to want to talk about, which is they could easily have taken the 60% enriched material and made a dirty bomb out of it. That would have been a really easy step. So there were all kinds of reasons to be concerned with where they were.
Our next guest has been one of those critics. Let's bring in Richard Haass, Counsel on Foreign Relations President Emeritus. Richard, I was asking that question directly after conversations with folks like you who said that the president hasn't laid out a clear case for why now this had to happen and what evidence there was that they were close. Were you satisfied with the answer?
Not at all, and thank you for having this naysayer back on the show. Nothing Steve Witkoff just mentioned, Sarah, was in any way new. Everything he just said was true 6 months ago. So the idea that the United States had to act when it did, that it had to act in the way it did without consultations, without explanations, never giving negotiations a chance, is simply unconvincing. All that said, we can have this conversation as long as you want. The real question is we are where we are. Where do we go from here?
Yeah. And the answer to that is, I mean, President Trump, he just told Axios in the last hour or so that here's the headline: there's practically nothing left to target in Iran, implying that we're close to the end here.
Well, we may be close.
What do you make of that?
Look, militarily, we're up against diminishing returns. We've gotten, I gather, most of their ballistic missiles. There'll always be some drones. There'll always be some mines. They can always rebuild. But militarily, we've run up against, again, a certain wall. The question is, just because we've decided we've had enough, there's two other parties to this. It takes three to tango. The question is whether Israel's decided that it has had enough. Clearly not. And just as important, more important, Iran may want to continue the war. So again,
neutralize that with a new supreme leader in power, who is the son of the old supreme Ayatollah, with equally hardline views.
I haven't seen that anything has changed to the physical status of the nuclear materials. They've obviously got a large amount of somewhat enriched uranium in the vicinity of Isfahan. You don't know, I don't know what other material may be scattered around the country, what centrifuges, what nuclear expertise. So we've not taken care of the nuclear challenge. My guess is we can't do that militarily. So sooner or later, the only way to deal with the nuclear challenge, the only way I know to end...
President Trump is always open for negotiations and you know, always wants a diplomatic solution, which is how we got here, which they weren't negotiating in good faith. I think the other question is just whether Iran remains a threat to the world, to Americans, to Israelis, whether they're going to be in bomb shelters again.
Man, I don't know what's going on. Why this system keeps freezing up right now. I don't understand it. Fourth time for your mind. Man, there we go. Okay, we got the stock back moving again. Grateful for that.
The chance before we were infinitely more flexible and patient when it comes to Russia vis-a-vis Ukraine, the same Russia that's helping Iran. I don't understand why we don't now give negotiations a serious chance. Iran is weaker, but we haven't solved the problem.
Just when you bring up the oil prices and the gas prices, I know it's painful for Americans and it may not be popular politically, but when you're after a peace in the Middle East, you know, and a once-in-a-decade opportunity to try to achieve that and make the world a safer place, it feels like something we can tolerate a little bit.
Sarah, if I thought there was a serious chance of quote-unquote peace in the Middle East, whatever that means, I'd say, yeah, let's go for it. But I don't see the opportunity. And it's more than just the gas is going to cost you more at the pump this weekend. We're talking about a massive transformational effect on the world economy if this goes on for months more. And I don't see where strategically we would be better off. We face real challenges in Europe and in Asia with Russia and China. We do not want the U.S. military parked in this part of the world. We don't want ourselves using up munitions at the rate you're using this up. This makes no strategic sense, and economically, this is really bad for the United States, for economic growth, any and every measure. So no, peace is not at hand. We've got to get serious, not about solving this problem, but putting a ceiling on it in a way that we can live with. Difficult choices, but we've got to start making them.
All right. Thank you for coming on and sharing your view, Richard. Always good to hear from you.
Thanks for having me.
Richard Huss, President Emeritus of Council on Foreign Relations.
All right, after the break, why a tried and true strategy for investing in memory stocks like Samsung and SanDisk is undergoing a big change. We're back in a moment. Welcome back. There is a shift going on in memory stocks as AI drastically boosts demand across the chips industry. Christina Partsinevelos is here to explain that. Hi, Christina.
Hi, Mike. Well, for decades, memory stocks were just a trader's game. Boom, bust, repeat. But the executives I spoke with across the industry say this cycle is different. HPE CEO told me directly, quote, "We will continue to raise prices because the industry will continue to raise prices. There's just not enough supply for demand." He's talking about memory. Even a Seagate executive told the South China Morning Post this week that memory prices hikes are likely to become, quote, "the new normal for the next few years." Seagate makes hard drives that store data on disks. SK Hynix spokesperson also told me the entire memory industry is undergoing structural change, that AI workloads require far more memory-intensive architecture than anything the industry was built to support before, and that's why customers are locking in deals well beyond a year. And specifically on the demand side, Micron management told me customers are now more than willing to sign long-term supply agreements, locking in memory for years. Marvell CEO, perfect example, said on his earnings call just a few days ago, he's locked in supply all the way through 2028. With hyperscalers, of course, crowding out consumer supply and no meaningful relief coming until at least 2027 at the earliest, memory stocks have surged. Micron up over 350% over the past year. SanDisk, which only listed in February of last year, up 1,000%. But these stocks trade almost like memes with incredible volatility. Just look at a one-month chart of SanDisk and Western Digital. What memory management is now asking investors to believe is that this time is different, that AI has structurally broken the old boom-bust cycle, and with long-term contracts replacing spot market deals and hyperscalers locking in supply for years, they may have a case. Guys?
Although it is a good question on what's on the other side of this. If it is a typical boom-bust cycle, right? After all this and after all they fulfill their orders in a few years, then what happens to demand?
Well, Sarah, that's applicable to the entire AI data center build-out, applicable to NVIDIA. What happens in the next few years when CapEx slows down and, some of these companies start pulling back? And this is very applicable to memory, but right now, everyone across memory and everywhere else is saying, no, it's for years to come.
Christina, thanks. Christina Partsinevelos watching Memory for us. Mike, thanks to you. We'll see you this afternoon on Santo Lee.
See you tomorrow.
4 p.m. Eastern Time.
Santo Lee hour.
After the break, how the war in the Middle East might disrupt billions of dollars in big tech spending when Money Movers begins. Good Wednesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen, live at Post 9 of the New York Stock Exchange. Today, we are watching oil again ticking higher as traders weigh the IEA's historic release of some
Alrighty, team, I'm getting ready to leave. But again, remember, we got our support and our resistance line. We're waiting to see what anything does outside of this box. Let's hold and be patient. I'll be checking back with y'all around 2.
Why he thinks this fuels uncertainty and spells trouble for the economy.
Meta unveiling some plans for 4 new in-house chips, part of its plans to rapidly expand its data center strategy. We'll get to that. As for the markets, a little more mixed today than in some prior example.
Yeah, Treasury yields have tracked oil higher on the whole inflation worry trade. Though I would note long-term expectations on inflation, like 10-year expectations, they haven't moved that much. But we will start with that breaking news on oil from the IEA last hour, agreeing to release 400 million barrels of oil from strategic reserves. Pippa Stevens first brought us that news and joins us now, Pippa, with how the market and the oil patch is digesting it.
Hey, Sarah. Well, this is the largest tapping of oil reserves in history, with 400 million barrels set to be released across the IEA's 32 member countries, about 1/3 of the 1.2 billion barrels in emergency stockpiles. Executive Director Fatih Birol saying, quote, "The oil market challenges we are facing are unprecedented in scale." The IEA not yet giving a timeline for when these barrels will hit the market, but said it will be at a time frame appropriate to the circumstances of each country. But the flow rate, or how fast the oil can get out of reserves, is what's key. JP Morgan estimates a daily flow of just 1.2 million barrels per day, meaning it won't do a lot to offset how much is being lost daily in the Gulf. For the U.S. SPR specifically, it's at 58% of capacity with 415 million barrels. Once the president decides to draw it down, it takes 13 days or so for the oil to hit the market. Now, CSIS's Clay Siegel telling me it's like an emergency fund in your bank account. It can buy you time to restore your income, but it can't replace it. So in other words, the world's economy still very much needs Gulf oil. Guys?
Pippa, yeah, you have to imagine the Iranians figured this would probably happen and maybe have a strategy for what comes next, or once these reserve releases are depleted. People are also talking about the tip of the spear being Japan, because some of those barrels are likely to hit on Monday.
That's right. So we saw Japan saying that they would release some reserves on March 16th. We also had Germany come out earlier and say they would as well. And the reality here is that Japan is very much more dependent on that Middle Eastern crude. And so we are seeing some of those Southeast and Eastern nations the most impacted thus far. The U.S. does remain a little bit insulated, but these are global markets. Just look at the price of heating oil, ticker HO. That was up 8% when I checked, which goes to show you that we can't make all of the diesel in the United States that we use. And so this is, a Band-Aid measure in some sense, just because these flows are so global and these supply chains are so intricate. And it's even the fact that, let's say the hostilities were to completely stop today, it would still take a number of weeks to reposition tankers, to restart the production that we've seen come offline. We have seen Saudi Arabia and UAE utilize their pipelines in Yanbu and Fujairah to offset some of those lost barrels, but it is not enough. And so the fact that the oil market is not even falling today, I should say, kind of indicates that maybe there are some perceptions that this is going to be wider and longer than initially thought.
Yeah, I think that was also an echo from 22, where the initial release was not met with lower prices. It did take a while for the market to come around to that idea. Pippa will be in touch. Pippa Stevens watching the IEA today. Big stock story of the morning is going to be Oracle, of course. Seema Modi's here following reaction to results and this better guidance on revenue.
Carl and Sarah, this was a reassuring message from Oracle last night. We're seeing demand accelerate with the backlog increasing $29 billion quarter on quarter. But here's the key. It's doing it without increasing its CapEx targets for the year. And perhaps even more importantly, its debt financing is not expected to raise more debt in 2026. So that's why we're seeing Oracle's credit default swaps plunge this morning. One way it is able to reduce its cash burden is by using this novel approach of asking customers to bring their own chips to its data centers that it is standing up. And on the status of its relationship with OpenAI, Oracle did say 90% of the 400 megawatt capacity it's delivered has on schedule. So that's putting concerns of delays to bed, and that it's continuing to build data centers for the future. Still, Morgan Stanley noting that there are longer-term financing questions beyond 2026, those tactical considerations like the equity sale that will dilute equity investors in the near term. But overall, analysts at JP Morgan say management has started the long process of regaining investor trust as well as their own credibility with this print. As for the AI displacement fears, Chairman Larry Ellison on the call last night said they're using AI coding tools, and that sets it apart from its competitors, and that's why the SaaS apocalypse does apply to others, but not to Oracle. It's important to note that still a majority of its profit is being delivered by its traditional enterprise software business, guys.
I'm just looking at the stock chart, so obviously a nice move today, but there are, I mean, it's well off of its highs. This was a stock that was, above 300 a few months ago, last fall. So is what ultimately is the nagging concern? Is it around the financing and the balance sheet, or something deeper with where they fit in terms of the AI ecosystem?
Yeah, I think for now the results were very encouraging for the near term. But to your point, the longer term story around what happens beyond 2026, what are other levers it can use to raise cash? I mean, there's been reports of a potential spinoff of Cerner. The company did hint at some type of restructuring and layoffs potentially in the cards. So the question is just what else it's going to do to maintain its current cost structure while at the same time ramping up the cloud infrastructure business, which is clearly seeing a lot of demand. And by the way, even on their earnings call last night, they talked about how, one of the reasons they feel confident about raising their 2027 revenue guidance is because of one of their main customers receiving a nice fundraising round. They're obviously hinting at OpenAI, which still makes up a majority of its remaining performance obligations. That fundraising round, that's giving them the confidence to say, hey, we can not only deliver on 2026, but raise that sales guidance for next year. Now, can they deliver? Right? We'll be watching closely.
On the multi-year guide. Thank you, Seema Modi. For more on the broader market, let's bring in Bespoke Investment Group co-founder Paul Hickey. I mean, clearly oil is still the barometer for which we're watching the war in Iran and how that's rattling markets. How would you say the equity market is taking the rise in oil and some of these headline risks?
I mean, I think it's been taking it amazingly well. You look at where the S&P is relative to its high, it's within 3%. I mean, given the greatest hostilities we've seen in the region in, many decades. So I think for all intents and purposes.
You think it's underpricing risk?
No, but I think you have to take a step back and look at what's the reason for this and think about it. So when you see oil price spikes like this, historically they tend to be short-lived. Right after the attacks, oil closed 3 standard deviations above its 50-day moving average. Historically, 6 months later, it's down 15%. You look at the energy sector. Despite rallying over 40% in crude oil over that same time, the energy sector was up 2%. So the energy stocks are somewhat telling you that maybe these high prices aren't going to stay there. So in that respect, I think, who knows what the future is going to bring? I don't know. But
I think market's looking past it.
The market tends to look past these things. It's had this experience before and tends to move on. And we'll start to focus on other things that like the economy and the broadening out.
Private credit.
Yeah, I mean, there's always a headache out there somewhere.
That was one of the great desk notes today out of Morgan Stanley, was the question of whether we have really ring-fenced the hostilities in the Middle East, stress on private credit, the pop of a bubble in the Kospi. I mean, that's a lot to handle.
Yeah, with an S&P 3% up high.
It's been amazing. And you look at, even before the Iran, we had so much. We had Venezuela. It was the longest it ever took the S&P 500 to have more than a 3% range year to date. So it took until March. Usually you do it by mid-January, you have a high-low range of 3%. So it's been incredibly stable at the index level. And I think part of that is the broadening out of the index. You've seen the mega caps sort of stall out. And even if they trade sideways, that acts as a weight on the market, whereas you've seen some enormous gains in individual stocks. You have more stocks in the S&P 500 up or down 20% this year than you do up or down less than 5%. And most of those stocks that are up or down 20% are up 20%. So you've seen a lot of strength underneath the surface.
I mean, one thing, Carl brought up the 10-year yield pushing to 4.2, and I do wonder if inflation is being more factored into the bond market than the stock market right now?
So, I mean, it's 4.2. When was the last time we were at 4.2? Like a month ago.
Yeah.
So, I mean, it's
just moving up. That's all.
It's been like the S&P 500. It's just moving up and down in a range. We haven't broken out of this range in either direction.
So you don't think the market is pricing in any kind of inflationary
No, I don't
spark?
think 4.2 on the 10-year is
No.
really the market worried about inflation at this point.
And should the market worry about a 10-year yield moving up?
I mean, if we were to go above 4.5% in short order, I think that would be a cause for concern. It depends. It's always how you get there. If you see 4.5% at the end of the year, which I wouldn't expect, that would be less concerning. But if you see 4.5 in a month or two, that would be a big concern.
The other fun sort of back of the envelope stuff that we got this week was at what price of oil are the tax benefits from the one big beautiful bill canceled out? Some argue it's in the mid 80s. Was the market, had that already been priced in?
I think, again, you have to focus on the short-term impact. Like, the market is looking at this uptick in gas prices. By the way, were they clapping at me?
No, not yet. No.
You're doing great.
No, but the short-term, the market's looking at a short-term increase in gas prices, and it's thinking this is going to be short-term. And so what you see is now, even after the spike we've seen higher in gasoline prices over the last 2 weeks, it's right at the 5-year average right now. So, again, it's been a big increase, but we were at very low, multi-year lows just 2 weeks ago.
I mean, part of it, okay, so energy is leading, not surprising because you have oil in terms of what is keeping the market holding up so well. Technology has been acting a lot better in recent weeks, but there have been worries, warnings from the analysts that cover, say, the software stocks that long-term still doesn't look pretty, this short-term bounce.
Yeah, so I mean, I think it's, Oracle's saying the SaaS apocalypse, whatever you want to call it.
It's not us.
It's not us and maybe overstated. NVIDIA said the same thing a few weeks ago.
So did Salesforce.
And so did Salesforce. So you look at that, and I think what you've seen is you saw, that's the Trini Research was like a washing out of the market. Since then, yesterday was the first day since the publication of that report that the software group didn't close higher than the open. So you've seen accumulation there. What I would look for here, though, is you saw the rally in software stocks occur as crude oil spiked, and a lot of that could have been degrossing of portfolios. So it was a big short position, people covering to, lower exposure to the market. I think what you want to see here is if you see oil prices stabilize and you see software stocks continue to hang in, that's what we're watching for as a signal of an all clear in the sector. You want to see software stocks stable even as oil prices, decline or remain flat.
Okay. We'll watch that relationship.
But then semis within tech, that's a sector we really like. They're the driver of AI, whether it's agentic or software stocks. Semis are the rails of the AI trade.
Yeah, nothing changing about that in your view.
Yeah, no, I don't think so.
All right, Paul Hickey, thank you from Bespoke.
All right, good to be here. Thanks.
Still to come this hour, how the war in Iran threatens the data center build-out and the billions of investments that the Gulf region has so far pledged.
Plus, we'll talk to a top venture capitalist in Tel Aviv on the regional business response to the war and the impact on the markets in Israel. Stay with us.
Welcome back. The Gulf region has seen billions in AI investment commitments, but the Iran war may now be threatening that data center build out. Our Kate Rooney's watching that story this morning. Morning, Kate.
Good morning, Carl. Good to see you. So before this war, America's biggest tech companies locked in deals to turn the Middle East into a global hub for AI and data centers. It's really been powered by billions of dollars from sovereign wealth funds in countries just across the Gulf from Iran. The AI gold rush did peak during President Trump's visit last year to that region. You had tens of billions of dollars in private sector deals struck with Microsoft. You had Google, OpenAI, Amazon at the time. It does come as Gulf states look to pivot their oil wealth towards this AI-driven future. There are some new security risks to those deals as existing data centers now become targets in this war. Iran did strike 3 Amazon Web Services centers in neighboring countries. Experts do expect the cost of fortifying some of these to increase in the future as they keep getting built out. AI is deeply embedded right now in the U.S. military as well, as we have seen with Pentagon and Anthropic fight lately. And as that technology becomes strategically important to the U.S., experts do worry that these data centers could become even more of a target. So it's not just the capital, though, as I mentioned. The region was also attractive based on access to cheap power, which is the data center's largest budget item. That is changing as energy costs become a lot more volatile. Analysts also fear some supply chain disruption amid all this. Semiconductors, memory chips, some are pointing to key materials like helium and bromine. And as costs go up, there are some new questions over what all of this is going to mean for big tech capex. So the hyperscalers are now expected to spend about $700 billion on the AI build-out. Gene Munster over at Deepwater telling me the conflict will likely increase cost. It's going to slow down the speed at which they can build all of this and then stretch the timeline for some of the spending well into 2027, guys.
I was just going to say, a lot of it does feel like near-term issues, depending on how long the war lasts. Ultimately, I mean, there's no fighting what's happening with AI. The trend there, and especially if, you know, the end result of this is a safer, more prosperous Middle East, could actually accelerate it.
That is the X factor, Sarah, of how long this actually lasts. And it's sort of, there's this irony that at the same time you're seeing the threat to AI data centers, this war is also underlining how strategically important
Only thing I'm doing, team, is resetting my alarm. The only thing I'm going to do right here is reset my alarm and see if we get a break. If not, look for a substantial bounce to the upside.
Near term, where they allocate and where they can look outside the U.S. as we start to see capacity limits with the build out domestically. Also, costs going up overall. So we'll see again how long this all goes on.
Okay, thank you, Kate. Kate Rooney. We'll stick with this theme exactly, tech and the Middle East during the Iran war. Joining us now is the co-founder and general partner of Israeli venture capital firm Aleph, Michael Eisenberg. It is an interesting question, which is, you know, the wave of AI is coming no matter what. So what's happening there on the ground as you have a sort of a front row seat to all of these AI innovative companies, startups across Israel? Is there a pause or anything like that?
Oh, quite the contrary. It's good to see you, Sarah. What's been fascinating, I think I've said this on your show before, is since October 7th of 2023, the amount of innovation at literally, unfortunately, the bleeding edge of technology has been just extraordinary. And we've seen just an incredible wave of companies that have come for funding ever since October 7th that is just groundbreaking. And their uses of AI, both in physical AI and digital AI, is nothing short of amazing. And I expect fully that when this war is completed, you'll see some of the same things. You know, when you have to operate at distances like this, you learn a lot through those interactions. And I think the other thing important to know about AI is that AI reacts by learning in the field, and you kind of constantly train these models. Well, we got a lot of reps on training these models now going forward. And I think probably that's, by the way, what led to the giant orders from Elbit. And I don't know if you know this, Sarah, but just today, a new Israeli defense company filed a prospectus with the Tel Aviv Stock Exchange. And apropos the conversation on the Straits of Hormuz, this company provides underwater sonar technology for maritime. I think that's pretty interesting. Filing of a prospectus in the middle of a war.
Yeah, I mean, it is. I do wonder, what is it like there on the ground? Are the missiles still coming? How much time are you spending in shelters? Obviously, they've called up reservists, and that can be disruptive to daily life and business. Give us a sense of what's happening there.
Sure, we were in shelters a couple of times last night, and I've been once today. I should have warned you before we came on that a siren could go off any minute. That's what happens here. And then I'll try to finish the interview and then run to a shelter. But yeah, it's
no, go to a shelter first.
Yeah, it's disruptive in one way, but Israelis are just incredibly resilient. You know, I have two founders that got called by one of the big U.S. tech companies a day and a half ago and said, hey, we really need you to come here and solve a problem. The two founders got on 2 different flights because it's hard to get flights to a place in Europe in order to get to the West Coast within 24 hours. And so Israeli founders are finding not only ways to deliver, but over-deliver during this time. And God bless their families who are holding down the front while they had to go travel to the West Coast of the United States. And just earlier this week, we committed to another deal. So I wouldn't say business is as usual, but the Israeli tech economy keeps on ticking during this. Unfortunately, we're used to this.
And apropos of this conversation today, Google actually closed the deal for Wiz. This is a $32 billion acquisition, the biggest ever. Wiz, of course, the Israeli company. So, I mean, things are moving. Interestingly, the Tel Aviv stock market is higher since the war began. I think it's up about a little less than 3%, and has been one of the world's best performing markets over the last year, despite, Michael, concerns about the fiscal strain of all of these wars, the munitions, the sort of cost on society and people. It is amazing to see this market so much higher. What do you think is the impact on the economy overall?
So let me talk about the rise in the Tel Aviv Stock Exchange since this Iran war began. What is very clear from the rise is that Mr. Market, who's smarter than everybody, understood that there was an Iran discount. What could happen if Iran attacked us? And I think one of the things that President Trump understood very clearly is that Iran was a compounding problem that is a threat to the global economy. And in fact, what Iran is doing, and your reporter was on before, both to data centers and to oil tankers in the price of oil, I tend to agree. And again, the price of oil, I tend to agree. And again, keep in mind, a ballistically armed and nuclear Iran would have been a far bigger threat to
I don't know why this keeps freezing. This is the 3rd time this has frozen, and I'm so glad I caught it before I left. This is just getting ridiculous. All right, it seems like it's unfrozen now.
Companies coming on pause because you had, I mentioned Google Wiz, you had a company acquired by Apple sort of quietly, I don't know, a month or so ago for $2 billion, Q.AI. So how do those deals happen at a time like this?
And again, we do have another
from
lower high.
The big tech firms, which
we're starting to see
major
what
source,
I want to see as we build up momentum to finally break through the 674.9 area.
Days has been difficult, so I haven't seen anyone turn up here since then, although some people were stuck here. But here, a little teaser. One of my companies is actually in the process of being acquired by an American tech company, yet another one. And the deal continues unabated. And just an hour ago, I got a call from one of my founders who thinks he's getting a term sheet from a big American fund. And so Israeli innovation continues at this point in time. The people here are incredibly resilient. Our children are resilient. And they're going to be a model for the West because, things are getting more complicated out there, whether it's, the fact that war is back, AI is causing changes we can't even imagine. The welfare state is struggling. Debt to GDP around the world is challenging. Having resilience, as I wrote in our Aleph annual letter, 2 things that have turned out to be super important. One is that sovereignty, particularly as it relates to digital infrastructure, is becoming a thing. And you saw the attacks on the data centers. I do think the Gulf is going to be a great place to put those things going forward as well. But you obviously see which side you're on this conflict has impacted your digital infrastructure. And the second thing is that Israel creates agency at scale, or people of agency at scale. And that agency is likely the most critical trait in this era of AI and global change that we're all living through right now. And so I think the future of entrepreneurship here is also very bright.
Yeah, I think it explains a lot of what's behind the big run-up that we've seen in the market there. Michael, thank you for the perspective on the ground.
Thank you,
Be
Sarah.
safe. Thanks for joining us, Michael Eisenberg.
Hope to see you in person soon. Thank you.
When we come back, how the war in Iran and this morning's inflation print could both impact the Fed's decisions moving forward on rates. Former Minneapolis Fed President Gary Stern will help us look at that.
Plus, as Salesforce's plan to take on debt to fund buybacks, a concerning sign for investors. We're going to discuss that when Money Movers returns.
Watching shares of Nebius today popping after news that NVIDIA would invest $2 billion in the AI cloud company. As part of the deal, the companies will collaborate on infrastructure deployment, inference, and AI factory design and support. NVIDIA will also give Nebius early access to
this is what we've been waiting on. We told you where the trade was. We told you. But now we have to make sure this is not a trap. The market has been wiki all day. You have to make sure this is not a trap. We got confirmation, we have continuation, but on a day like today, you have to go one step further, to be careful, to be patient, to be cautious. This could very well be a trap. We still are within that shaded box area. That alarm means that the market has my attention, but it does not have my money yet. But I am getting very, very close to entering a trade. Let me go ahead now. I want to take a step back, look at all of the other time frames along with that. I'm looking at the 15. I'm looking at the 30. And again, the 30-minute chart illustrates who I'm looking at, who has my money. Let me go ahead and identify that real quick, where my money is going to come from. And it's going to come from the bulls from Monday afternoon at 3 o'clock. These bulls, this are the ones I'm looking to put pressure on. Okay, they're uncomfortable right now. We go below the 674. We can expect them to really start heading towards the gate, taking profits, and possibly the further it goes down, even covering. But there is still bullish strength. I need to show you this on the 30-minute chart so you can really see that we're still in this sideways actions. Up, down, up, down. Now we're knocking on that door of support yet again. But if we crack it this time, these bulls may start heading toward the exit gate. Again, the market has my attention, but it doesn't have my money just yet. So I am going to replace that alarm there. Okay? Replace that alarm. Bam. And again, that's looking at the larger time frame, which is what we want to do in a situation like this that we're experiencing today. Look at that larger time frame before you fully commit. Yet another bounce appears to be happening at the 675. Yet another bounce. I'm good with that. So guys, keep your eyes on your larger time frames. This is setting up as a bullish reversal. Beautiful hammer. This is going to be a nice 5-minute scalp trade. 5-minute scalp call potentially. If not, this could be exactly what we need to see to go down further as these trap bulls and this tail. We know a green hammer shows bullish strength. A green hammer is a bullish reversal sign. Underneath that, you have bulls rejecting lower prices. The bulls reject lower prices from 674. The market comes back down towards that area. Those bulls will have to cover. That will start that bear domino effect that I'm looking for. Again, being patient.
Welcome back. Largely inline print for CPI inflation this morning. CNBC senior economics reporter Steve Leisman has a look under the hood at some of the individual components, Steve, and what inflation may be coming on the way. Everyone's looking to March now.
Yeah, that's true. The good news in today's report, Sarah, is that it was in line with expectations at a relatively modest rate. The bad news, the components that move over into PCE from this report, which is the Fed's preferred inflation indicator, suggest a stronger report coming, and there's likely, obviously, considerable top-line inflation to come from the oil price surge. Here are the numbers. Instead of giving you the individual prices of all the boxes behind you, we'll put them together, 0.3%, and that's a tick higher than the prior one. But the year-over-year stays the same at 2.4. That's a good number. And then again, on the core, 0.2, a tick better than the prior month, and the year-over-year stays about 2.5%. Let's look at some of the components here. These are the hotter ones. 0.4 on food and on food at home. Food away from home was also 0.3%. Energy up 0.6. I don't really like that number because we're going into an energy price inflation number. Apparel up, that could be reflecting some tariff issues here, along with household furnishings and recreational goods. And then medical services, well, 0.6%. That is a hot number. Rob Houston, former from EY Global, writes, February CPI shows inflation may be easing on paper, but consumers are still feeling the pinch, and they're feeling it unevenly in every grocery and gas run. But looking at places where we had good news on inflation, 0.4 on used cars and trucks. This shelter component is a big part of CPI, and it's really depressing the total here. Goods, apart from some of the tariff overall.
Ben said maybe CNBC is doing it.
Electricity also down.
Quiet Soul said, what is going on?
Year. Let's get rid of these and take a look at a little formula here.
He said, I'm also saying that the market makers are up to something. They are.
Other economists have a
Hold on, let me move
formula.
him. I don't want to compete with this guy. This just might just really be a good observation day, team. The market is definitely in a range. You can clearly see the range. We are coming down a little bit lower from the range, so I could possibly move this box down some, even though I'm not going to. Again, there's nothing wrong with buying a call at support. We saw this beautiful hammer, beautiful green hammer at that. Only thing you need to see is about wait another minute, see if we get a close above that. Put this last, what is this? This 11.25 bears. These 11.25 bears, they are seem the one that are in the driver's seat right now. The 5 is underneath the 20. We're down here at the 675 area that we've been before, knocking on the door yet again. We cracked it this time. The bulls got a little scared and bounced right back, as I'm showing you here to the left highlighted who we are up against, who has our money, who we are looking to cover in order for a put to work in this area, but also who has the strength, which why a put will not work in this area. Hurry up and wait. Hurry up and wait, man. Hurry up and wait. I'm really leaning towards the afternoon because a lot of people that's trading after 11:30 are people who've lost money in the earlier days, in the earlier time frame, and they're trying to make up for it. So we want to be careful and mindful of that.
Unemployment has basically slowed to a halt. I mean, employment growth, that is. Unemployment rate is a little bit elevated, and they might want to get ahead of more pain for the job market. And when it comes to inflation, look at core. You know, strip out food and energy, which is volatile and can often change in a few months.
I think all of that is correct, and I should have put an asterisk next to everything I said, which is that if we're losing 25 or 50,000 jobs a month, then all the other stuff doesn't matter. I think the Fed reacts to those. I think that's right. But what I am concerned about, I can't bring it back up, but that shelter component, Sarah, which you know is having a big impact on core, there's a lot of commentary this morning, and has been around for a couple weeks now, that the shutdown and the changes they made to the methodology from the shutdown
Quiet Soul says 3 out of 9.
As much as 0.3.
Big Ben said quick call scout. It would have been if we would have got a close above it, and that's why we wait for the candle to close. It actually came back down and did not do that, which also makes it stronger for the bears. However, looking at the sentiment of the candles are showing indecisions right now with 2 very small body range candles here at 11:45. Also look at the volume. The volume is starting to die down. The volume is starting to die down. We're not seeing the volume that is necessary for a big move that we all are looking towards. So again, continue to be patient.
A variety of transitory elements that are very significant and that are underway right now. The obvious problem is we don't know how transitory they're going to be because uncertainty is very great right now, starting with the war in the Mideast and where that goes. But then you have a lot of other currents in the economy, all the developments in AI being another one. And lots of uncertainty about the future of the labor market, uncertainty about the underlying momentum, if any, in inflation and so on. So I think this is the time where, if you're a policymaker, you want to be patient. There's no great advantage in pulling the trigger when you don't have really sufficient and sound information to urge you to do so. So, as I said, patience seems to me to be a virtue, if not in all cases, it's a virtue right now.
Right. Do you think that's a winning message for Warsh on the Hill?
I do. I don't think you want to pretend to know more about the future than, in fact, you know. And I've already identified a number of uncertainties, and I'm sure I could come up with some more. So I think that will transfer well to the Hill. I think Kevin Warsh is a very wise selection. He knows the Federal Reserve and the issues it confronts very well. He's very smart and astute, and he's a decent guy. So it was a good choice. We'll see how the confirmation process goes.
How inflationary do you think this rise in oil prices is at this point?
Well, it would be permanently inflationary unless the Fed underwrites it, because you have cross currents, and certainly for a time, the overall CPI and the overall personal consumption expense.
cents a share or $75 a contract. So in essence, stock stays nested between the short strikes of 79 high and 70 low. That 75-cent premium will erode to zero. Your return is 75 cents, but your risk is, of course, there's no free lunch, always some risk, is 225, and that only occur if the stock hits 82 or higher or 67 or lower between now and expiration in 9 days.
Meta revealing new details about its in-house chip production this morning. Julia Borston has the details. Everyone's going in-house, Julia.
That's right. Meta today unveiling 4 custom in-house chips. This is the tech giant's latest AI infrastructure announcement as it works to future-proof its supply chain and create chips tailored to Meta's particular needs. Now, the chips are manufactured by Taiwan Semiconductor, part of what the company is calling the Meta Training and Inference Accelerator, which is starting with tackling Meta's most basic needs and then expanding to more sophisticated ones. So Meta is already producing a chip model to process the likes of Instagram and Facebook's rankings and recommendations, and it's working on 3 others designed for AI-related tasks such as creating images and videos from text prompts. Meta's VP of Engineering, Yi-Yum Song, saying this, quote, provides us with more diversity in terms of silicon supply and insulates us from price changes to some extent. Going on to say this is a little bit more leverage. Now, this shows Meta working to diversify away from reliance on a few high-cost deals with chip suppliers, particularly for the most sophisticated AI like LLM training. Now, last month, Meta expanded its chip deal with NVIDIA and struck a deal with AMD, committing to acquire $60 billion of AMD's AI chips over 5 years. Also last month, Meta signed a multi-billion-dollar deal to rent Google AI chips. Now, while the chips Meta is now creating aim to tackle the platform's core tasks as efficiently as possible and are not yet focused on more complex large language model training, CFO Susan Lee did say last week that they're hopeful to be able to expand their custom chips over time to be able to train AI models. Carl?
They have been awfully busy, Julia, that's for sure. Julia Borston, thanks. When we come back, should Salesforce's plan to take on some debt to boost buybacks be a warning sign for investors? Tech Check will look at the return of the levered buyback in just a minute. Moody's downgrading Salesforce as the company reportedly kicks off a debt sale of up to $25 billion to fund some stock buybacks. Our Deirdre Bosa is watching that in today's Tech Check. This is definitely making the rounds, Dee.
It is. Morning, Carl. So one way to read this deal is that Salesforce is borrowing to buy time and not growth. Now, this would be the largest bond sale in its history, and it's likely a show of confidence from management. But the money is not going towards a new product acquisition or AI infrastructure. That's the stuff that everyone else is spending or borrowing for. Debt-funded buybacks, they work only as long as the underlying business itself justifies the bet. For Salesforce, the poster child of the software sell-off, tripling its debt to prop up the stock price is a gamble that AI disruption fears are overblown. But if management is wrong, the balance sheet could make things worse. Now, to be fair, you can see why management feels confident on the surface. They just beat earnings, revenue over $40 billion, free cash flow. Agentforce, their AI platform, is growing nearly 170% year over year. But you dig a little deeper, and Agentforce is actually still less than 2% of total revenue. The stock is down over the last 5 years. And while other software names like ServiceNow, Datadog, Shopify, while they have bounced this month, Salesforce is flat. So the market is starting to pick favorites in the SaaS sell-off. CRM isn't one of them, at least yet. One more thing that's worth flagging here, Salesforce pays its employees roughly $3.5 billion a year in stock. That dilutes existing shareholders, so a meaningful chunk of every buyback, it's not actually returning capital, it's just offsetting stock-based compensation. Now, investors have spent years telling Mark Benioff to stop doing acquisitions and return capital, so that's what he's doing. And Sarah, I know that you spoke to him. He said the number one great value out there right now, it is CRM, it's Salesforce. But he might be right, but levering up to buy back stock, that is the playbook very reminiscent of IBM and the old Oracle before AI, not a company that is pioneering a new AI age.
Yeah, I mean, they just feel a lot of conviction about where the stock is right now. And it was interesting, I also, in the interview, asked him about M&A, because all these software valuations, you know, according to him, have gotten so cheap. And he said there are a lot of interesting opportunities out there. It didn't really go beyond that, but said we have a very disciplined approach to M&A because, as you said, he's been pushed by investors, I think, to be really disciplined when it comes to that answer and the use of cash. But it's not like he's the only one borrowing. I mean, Amazon, or like a lot of them are tapping the debt markets right now.
Yes. And I'm so glad you bring that up. I didn't have time to get to it in that segment, but that is a key point here. So others like Amazon and Oracle, even Alphabet, they are borrowing, but they're not borrowing for buybacks. They're borrowing to fund growth. Many of them are spending on infrastructure, which will bolster the AI bet. They have sort of a plan, whereas Salesforce and Benioff, they're borrowing to buy back stock. They don't have any better ideas. I know he's been burned by M&A activity in the past, but I mean, you're living in the age of AI. And Sarah, you're exactly right. There may be some compelling companies, beaten down companies out there. He's choosing to buy back his own stock instead of spending on a growth playbook.
Yeah, well, that one's been beaten down too.
That's generally the big complaint about buybacks over time, is that if you don't, if that's your best idea for capital, you got a problem. But to Sarah's point, maybe high degree of conviction that the shares are truly undervalued.
Yeah, right? I mean, and he was here on the show last week to make that case of what they're seeing in terms of underlying growth is it's accelerating because of AI in the CRM business, and also that they're adding business and Agentforce as well, which is, I think, you know, up to $800 million.
I know. I go back to the Agentforce thing, though. Yes, it's compelling, but I mean, this is a company growing at a much slower rate than it has, you know, years ago, and Agentforce still just 2%, less than 2% of total revenue.
Yeah, no, 10 to 12% is not, you know, the 20%, but it's also gotten a bit bigger. I think he would know, to become a little more mature and a bigger company. Deirdre, thank you. Deirdre Bosa, strong Canadian accent there in borrowing. Tomorrow we're going to get Dick's Sporting Goods, another read on the consumer, which, you know, has been actually an outperformer in its category, and then PCE is the big report on Friday.
Yeah, where some of the readings coming in a little warm. Goldman, I think, is at 34 bips or something like that. We'll see.
Some of the components from today's CPI that factor into PCE were a little hotter.
Yeah. Let's get to Frank Collin in for the Judge on the half.
Thank you, Carl and Sarah. Welcome to the Halftime Report. I am Frank Collin, in for the Judge, Scott Wapner. Front and center at this hour, navigating the volatility. More big swings in store for stocks as geopolitical uncertainty looms large. The Investment Committee is standing by to break down the setup for your money and much more. Joining me for the hour, we have Joe Terranova, Shannon Sakosha, Jason Snipe, and Steve Weiss. But first, very quick check of the markets. Take a look. We're in the red across the board, as you can see right now. The Dow pulling back almost 500 points. The S&P down just about 0.5%. The Nasdaq pulling back 0.25%. And look at oil. Oil actually up over 5% right now. Crude trading just under $88 a barrel. And really, I think, Joe, that's where we have to start at. We've seen so much volatility in the markets in recent days, a lot of it driven by the price of oil. Oil's up 5% even after a historic release by the IEA. And we're certainly in a headline-driven market. How do you navigate all this?
It's interesting because I think there's two different perspectives on this. If you are in the wealth management industry, you're looking at the environment right now, you're asking yourself, do you believe fundamentally we're at some form of an inflection point that warrants going in and adjusting portfolios? And I think the answer to that is no, based on the evidence. I don't think this is an inflection point. I think this is more of cyclical volatility, more of a cyclical correction. If you are paid on your revenue production, if you are a hedge fund, which Steve knows that world well, if you're institutional, you're focused on alpha generation, this has become a horrible environment to do that. And less is more. And you are participating less. The extreme volatility driven by whether it's a tweet or a headline, that's a very punitive environment to be in. So the people in that world that I speak to, they are providing less liquidity. They are stepping back. They are awaiting some degree of certainty involving the oil market. And then we do have two other headwinds in front of us, one of which is software. We'll talk a little, obviously, about Oracle in a little bit. But the other is the financial sector. And let's remember, the financial sector right now is down most of the 11 major S&P sectors year to date. It's having another awful day once again today. And I think that is also a very significant drag on the major indexes.
Weiss, I mean, he just talked about you and your other peers in the hedge fund community. Is that how you see things? You just want to pump the brakes a little bit right now, hold off on making any moves until the volatility dies down?
Yeah, look, return is defined by your point of entry. And right now, we don't know if the point of entry is the right point of entry. Now, if you take a very long-term view and you say, you know what, so-and-so stock has gotten cheap enough for me, I'm going in, and if it falls another 10%, who cares, right? You're taking a long-term view. But look, markets are hard to predict normally, and predicting all the crosswinds, tailwinds and headwinds, how they're going to fall into place, and if they come into existence, is virtually impossible now. So for me, it's pretty much, staying where I am, and I've got a quality portfolio, staying there. If something gets ridiculously inexpensive, like a Netflix or Microsoft, I've added recently, or Alibaba, which, apologies to the producers, I added to yesterday, then that's fine, because I know what the long-term story is for them, regardless of market and volatility in the market. So my advice is, don't get upset about the volatility. Don't try to trade this volatility, because that's really a sucker's bet here. The best people I know aren't willing to trade it, and I think just hold what you have. Don't panic out. That's always the worst thing to do. And we'll just see how it turns out. Nobody knows. What the critical impact's going to be, in my view, is not only how long oil stays elevated, and I'm not surprised to your point that it's not responding to, the massive, release of the reserves, because that's been well advertised. If they didn't release it, then you've seen something else in the market. But we're also going to hear more job cuts, substantial job cuts from AI, and to me, that's a short-term positive, but a interim, medium-term negative. So I would stay away from consumer discretionary stocks.
All right, you mentioned two interesting points. Number one, the uncertainty, and also the entry point. Shannon, I want to come over to you. Bank of America actually out with a note about this earlier today, saying in part, policy uncertainty is the highest since 2025 Liberation Day. We all remember that about a year ago. And history shows that extreme uncertainty has often marked good entry points for long-term investors. Now, everybody in this market is not a long-term investor. What do you think about this volatility near term? And if you are a long-term investor, where do you put money at right now with the thoughts that things are going to rebound and settle down?
Well, we are certainly long-term investors, and so I think one of the challenges here is balancing out, to your point, what our views were coming into this year in terms of what we felt would outperform and what was kind of relatively well situated, with the acknowledgement that we expected there to be some additional volatility, particularly on the policy side. So if you're in an environment where you expect there to be dispersion, our view was that the underlying economic momentum and the fundamental aspects of things like the transmission of the OBBBA, kind of tax relief coming through, lower interest rates, improved sentiment, and potentially an uptick in M&A activity, all of that pointed us towards what we felt was a basket of quality stocks, not just here in the United States, not just large cap, small and mid cap stocks. Ex-US developed, emerging markets who, frankly, for many of those economies have hit the inflation challenge head on and have a really nice balance sheet and current accounts. So our view is that in this environment, all of those things can continue to be allocated to in alignment with your allocation that you started the year with. I think tactically, you're also starting to see signs that there may have been some overselling in some of the areas that, perhaps we were not as constructive on coming into this year. So technology, for instance, you've seen a meaningful re-rating. But most importantly, I think the dispersion, the divergence, the differentiation between names that we anticipated this year has really come to the fore. On the fixed income side, Frank, we don't talk a lot about that here. But there's actually some opportunities in duration right now. I think we're all focused on credit and credit quality. You look at what's happening in the high-grade bond market, the issuance this week, you're looking at the potential for further curve steepening, especially if we move past the Middle East conflict. So I think kind of reiterating where you stood at the beginning of the year, looking at the underpinning of that thesis, and then taking these opportunities as they're being presented to you is critical if you're looking past the next 6, 8, 12 weeks.
All right. Jason, we'll come over to you. Joe mentioned the wealth management business. That's the business that you're in as well. What are you telling clients right now? I'm sure some people want to take some chips off the table, I would imagine, because some parts of their portfolio have been under pressure. Where are you seeing the opportunities? Where are you seeing areas that you think might be seeing long-term damage?
Yeah, no, I think it's a little bit of the play that's already been moving so far this year, which is obviously the infrastructure, AI beneficiary stories, the Eatons, the GE Venovas, the Cornings of the world. I think those stories still remain intact. I think the other opportunity is, to Shannon's point, what's going on with tech. The hyperscalers obviously haven't meaningfully participated so far this year, and I think you always, in geopolitical events like we've experienced, there will always be dislocations, and you always got to do a pulse check on where we are in the cycle. So I do think the hyperscalers are an opportunity. That's another place where we're looking at. And I think software now trading at 16 times forward, which is below a market multiple. I think there will be opportunities there as well, because I think there's a harmonious play with AI and software on demand. We'll see how this story continues to play out, but I think those are a few of the areas where there's opportunity.
Yeah, a number of recent notes saying this is an attractive entry point for software, one of those areas that a lot of people seem to be putting some money in. I think we have to go back to oil. I'm looking at oil right now, up about 4.5%, almost 5% right now. And I said this on Closing Bell the other day. We keep having people come on, whether reporters or traders like yourself, saying ever. Biggest release from the Strategic Reserve ever or since. WTI had one of the biggest price moves yesterday since 2022. Joe, you made some moves in the oil space. How do you play oil here, or should you even try with so much questions going on about the Middle East? And I just want to point this out in my world. Maersk reporting an issue in Oman just a short time ago, about an hour ago, saying that they're shutting down operations there. So we continue to see issues outside just the oil market with this conflict.
So you had to, I think, get in front of it in terms of energy allocations. In the fourth quarter, it was very clear, to Jason's point, the market was making a shift away from high beta, a shift away from momentum towards quality, towards defensive. Healthcare, leading sector. Energy began to make its move in the fourth quarter. So in front of that, refiners were clearly some of the energy names that you wanted to own. I own Valero, I own Phillips 66, I own Marathon. Till this day, I still own Valero. I think you maintain exposure there. In addition to that, I have EQT. So I think you had to be kind of in front of it. If you're now in the moment and you're trying to race to catch it, you're not going to. Because it's the equivalent of the Rocky movie where he's chasing the chicken trying to catch it. You're just not going to catch it. And if you think about what's gone on here, with the actual spot oil market. I gave some statistics the other day. I said at the end of February, the average volume for spot crude oil was somewhere around 300,000 contracts per day. We had bumped that up to 1 million once we had the conflict that began with Iran. Now what we're seeing is that figure's coming down once again. And what that's telling me is that professional oil traders are doing exactly what I'm suggesting, what I'm advocating for. They're stepping back and they're saying, wait a second. These headlines, they're just dizzying. The tweets, they're dizzying. I can't get in front of, I can't profit from a headline or from a tweet. And I think a lot of people are basically stepping back. So I don't think you're chasing it here. I think if you were fortunate enough to have the energy exposure coming into it, you maintain it. But certainly I think at this point, oil could go up or down 10 or 15% on the next headline or tweet.
You know, when you said the Rocky reference, I thought you were going to go Adrian yelling at Rocky that you can't win when he was supposed to fight Mr. T, because it's kind of hard to win with this oil trade right now. Shane, I want to come over to you. There's another side of this position. Piper out with a note saying, in part, not your 1990s oil shock. They go on to say, in fact, unless prices for oil are above $100 for a sustained period, many months, the impacts to core inflation and GDP are likely to be surprisingly modest. Now, that's the economy, not the market. Do you agree with that take that perhaps some of the reaction to this may be overdone? And unless this lasts many months, which it could, nobody knows, and Weiss, you've been great pointing that out. We don't really know. We don't know what's happening over there, that this isn't as big of a deal as it seems to be.
I think what you have to really differentiate between is it the energy price movements and how they're impacting today's kind of discretionary and non-discretionary basket for the U.S. consumer? Or is it a longer-term period where higher oil prices transmit through a number of different industries and then become a pass-through to the consumer? And I think that requires a significant amount of time in terms of the duration of this oil shock. It's also important that we understand that, you know, the part of the rationale for the U.S. perhaps holding up a little bit better from a market perspective than what we're seeing for our colleagues in Europe, for instance, is that we have access to more diversified production from an energy perspective today than we did 30 years ago, or whatever point in time you want to reference. And so we are not insulated from these moves in gas and oil prices, but I think that we're better insulated than our compatriots over in Europe, for instance, and to some extent certain economies in Asia. So I think that is an important piece, is the duration is not just about how long the U.S. consumer or U.S. businesses can digest higher energy prices in the here and now. It's having to then factor those in to end prices along the supply chain, which, as we know, is much less transitory and has the threat of being more structural.
Yeah, I think the issue is, to your point exactly, is that, look, there are certain businesses that have a fuel surcharge, and that may be freight. But when you click on Amazon, you're a Prime member, free delivery in 2 days, somebody's paying that surcharge, right? Yep. And ultimately, it's going to be the consumer. First, it's going to be the company. Now, when you raise prices because energy prices are going up, I don't think we ever really see those prices come out if it's not as a surcharge. So the longer term effects of inflation are going to exceed the time frame of the war and the destabilization in the energy markets. So that's what you have to be careful of. Then the reason why I wouldn't touch consumer discretionary, I wouldn't touch retail here, is because 2/3 of the country lives paycheck to paycheck. And they're already making decisions, unfortunately. What do I not buy so I can put food on the table, where we've seen prices go up? I've got to use my car to get to work. I'm worried about my job. So what's that all come down to? It comes down to less shopping at the Gap, less shopping Picket, right? Mm-hmm. So those are the issues, and those issues aren't going to go away when you have a president whose approval ratings are so low, and the general consensus on his handling of the economy is so low. There's a fear factor out there. So that informs consumer spending habits of the 2/3 of the economy that really matter. And that's where I'm concerned. Throw in the AI job losses, and I think you've got a major problem.
But don't you think there are some opportunities being created in areas like fast casual, in areas like travel, which frankly TSA throughput continues to rise actually over the course of the last couple of months. So I don't disagree with you, Steve, on that. I just think one of the things is to really look at again is that dispersion and try to price in, what is that additional impact that we could see if we're only looking at a 2 or 3 week duration from here on out.
Except, for dining, like fast casual dining and travel, they've been holding up pretty well. And because the airlines, let's face it, they're all monopolies in markets. So they own the pricing, and their bookings generally are pretty far out, where they were booked before the fuel surcharges and all that. So somebody's going to suffer hits of margins, but I guarantee they can make it up.
But if you look at ticket prices right now, I think you're going to see some of the impact of those higher costs. Those people got a discount.
It was already insane.
Well, I mean, compared to what it is now, if you bought a few weeks ago, that was a discount. Jason, I want to come over to you. I want to go away from the economy for a minute and come back to the markets. Does this rise in oil prices? We're looking at the Dow today, showing it just now down about 1%. Does this change the broadening of the market? Does this change the attractiveness of the halo trade? I believe that was christened right here, or another trade that actually came from Bernstein, Dave Vernon, great transportation analyst, the iron trade, infrastructure, real assets, optimizable network effects. That's another acronym that he's put out there. But the idea of these real economy trades, does it change that narrative?
I think in the short run, absolutely it does. And I think to everyone's point, it's about the duration on how long this actually lasts. If I think about the Strait, 120 ships pass through that Strait every day in a normal environment. There's no movement. I think that's possibly why, yes, I think this release today, this significant release, is baked into the market. But it takes a lot of time to get these ships moving again. This is a weeks and weeks story. So I think the longer we continue to deal with this, the more impact it will have. I think to Steve's point again, 70% of GDP is consumer spending. The disproportionate wallet share, 50% increases payment at the pump hurts these folks and how they kind of change what they're doing from a consumer and discretionary spending perspective. I think as we look at transports as well, the FedExes, the UPSs of the world, they obviously have pulled back. I think the Amazon point is well taken, but I think it's all about duration, how long this continues to play through, and I think we need to get movement. Everyone knows that, but that's the real story here for me.
I think the consensus expectation is that $90 oil is not going to be the price as we move towards the fourth quarter of 2026, and that's why I said this isn't an inflection point if you're in the wealth management industry where you're thinking about making significant portfolio reallocations. I think where you lose comfort in the economy is if, in fact, yields were to begin to spike. And now, look, we're up 5 basis points today. The 10-year's at 4.21. That's not overwhelmingly troubling, but it's going in the wrong direction. I don't think the market likes it very much, and it shouldn't like it very much. To me, that's more of a concern when you think about going forward into 2026. Rising oil prices, I think there's a remedy for that. Rising interest rates, that's a little bit harder.
Just to put a button on this, and to your point, Jason, actually Maersk came out today. They say they have 100 container ships stuck in the Middle East, and they say it'd take about a week to 10 days to get things, quote unquote, back to normal as we all adjust to this new normal. Want to switch gears now to one of the bright spots in the market today, and of course, that's Oracle. Take a look at this chart right now. Oracle shares up almost double digits right now after earnings. I think the question is here with Oracle, this has been a very volatile stock. It's fallen well off of its highs just a couple of months ago. A lot of questions, and Jason, I see you nodding here. Are all the questions answered? Are all the questions answered when it comes to Oracle? And is this just about Oracle? Because we've also talked a lot about Oracle being the public proxy for OpenAI. OpenAI making some deals and some controversial statements in recent days and weeks as well. So is this just about Oracle, or is it a read on something else?
Well, let me just speak to the print. I think the print was obviously a phenomenal print. I remember we were here several months ago talking about the RPO numbers, right, north of $500 billion.
But those came under question, right? Almost after we had the conversation.
In terms of execution, right? But this is the first quarter in 15 years that we've seen double-digit, 20+% EPS and organic growth return for the quarter. So I think that was a big story. I think the other story is reaffirming the guide in terms of CapEx, which is a $50 billion number, and I know these are major dollars, but when you, on a relative basis, compared to the other hyperscalers, they did not raise CapEx. So I think that was a big story for the print. And then when you talk about this 10 gigawatt data center build out, they are moving forward the strategy where there are folks that are prepaying and bringing GPUs to the table. And I think that is also an important story as you look at what has been the chinks in the armor: negative cash flow, negative free cash flow. I mean, I think that's been the big story. So I like this print. Let's see where the momentum takes us going forward.
All right, Jason, you're a shareholder. Joe, you own this one in the Joe T ETF as well.
Yeah, I believe it advances the premise of stability. And I think in beginning of early February, you were questioning that. Around February 5th, we reached a low somewhere around $135, $136. You've stabilized price since then. What this report does is it gives you a degree of confidence that there actually is the cloud computing execution that allows them to go forward with that $50 billion in CapEx, which they've talked about. OCI, the Oracle Cloud Infrastructure, coming in with a really strong number, up 68% quarter on quarter. That's better than expectations on a year-on-year basis, coming in above the consensus at 79 at 84%. Again, that's a really strong quarter. So is it blue skies? No, and it shouldn't be blue skies because there's real questions as you look forward into the future. But I do think this conglomerate has seen some of the massive storm clouds that were present at the end of January into the early days of February dissipate.
Yeah. So, Shannon, I want to come to you. I know you don't own Oracle, and I know you're not a tech analyst, but I want to go back to that RPO number. And Dan Ives came out with a note saying the story just remains all about their backlog, which is RPO minus OpenAI. I'm looking at this number, $553 billion, quadrupling year over year. Now, is this a bellwether of what's going on in tech in general? Can we look at it that way, or is this a single stock story with tie-ups to some big private companies?
So I think the challenge here is that we came into this year and we were battling this tension between oversupply and then obsolescence. And now I think, frankly, the conflict in the Middle East has allowed investors to take a step back and understand that the story is somewhere in the middle. I think that there's no doubt that if you look at, especially the scrutiny that Oracle has been under over the last year or so, that it's incredibly important for them to come out and allay the fears in terms of, most importantly, the debt that they've taken on to be able to service and build this backlog, right? So I think the challenge is here is that with each of these announcements, you get a more and more nuanced story, and that's incredibly important for this market because there's questions about the monetization, there's questions about the duration and the timeline of when these investments are going to pay. But I think more importantly, I think people have had a few weeks to take a step back, maybe put the pot in the, on the back burner, on the simmer, and have time to look at the fundamentals. And so I do think it's important not only from an equity perspective, but perhaps even more so from the credit perspective, where we have seen a lot of pressure on tech.
It really isn't lifting, though, the software industry today. When you look at it, the IGV is still down. You have Salesforce down. You have Adobe down. The names that we own in the ETF, Palantir, Zoom, Cadence, they're all down as well. So it's not like there's this universal feel-good story surrounding software today because of what we heard from Oracle, which I think some would have expected.
But that's don't you think that's because it's somewhat idiosyncratic in terms of that story with Oracle over the last year or so?
And also, in all fairness, Salesforce is actually down on a downgrade from Moody's as well, which may be dragging the sector today. Because sentiment's been pretty high, and we have a lot of notes. D.A. Davidson saying for the first time in 5 years it's investable on Monday. Deutsche yesterday upgrading tech to overweight. I mean, Weiss, I don't want to leave you out of this conversation. How are you looking at software right now? Are you looking for opportunities, whether at an ETF level, sector level, or maybe a single stock level?
For me, it's Microsoft. Look, I think software is going to be very challenged. I mean, when you can write code without ever having learned how to write code, that's problematic for software companies. And that's Salesforce, and that's Adobe for sure. It's all the others. I mean, look, it's people want to say, well, that's ridiculous. Can't get rid of Adobe. It's not so ridiculous. We've seen plenty of companies that were the company in that space that are far less relevant today than they were before. And that's an Intel, that's an IBM, the list is legion. So we just don't know. So you go to the one that was earlier in AI that has other major revenue streams and that is an innovator, and to me that's Microsoft. That's the only place I'm really willing to bet. I see no reason to go to Salesforce because when you talk about CRM, that's easy to replicate. Now, I'm not saying it's easy, anybody can do it, but I'm saying if you're a company and you take a look at the IT budgets, and I've heard them talk about it at JP Morgan, at BlackRock, at others. Those are massive budgets. I mean, take a look at what their license fees are to a Salesforce and to others. They're highly motivated to create that product internally for their uses, and that's exactly what they're doing, and we've seen them do it already. You know, in terms of being able to get rid of analysts, for example, investment banking, because it's automated. And we look at companies all the time for our analysts do the same thing. So I just think it's treacherous, catching a falling knife. You can look at what the mistake people make is that they say, well, the valuation historically was 25 times EBITDA, and now it's 15 times EBITDA, so that's on sale, that's a buy. But the fundamentals have changed, so the old valuation metric just doesn't apply. Maybe it will, but nobody has the vision to know if it does or doesn't.
Yeah, a lot of uncertainty out there. And to Joe's point, the IGV down over 0.5%, falling more than the broader market. Speaking of the issues for software. All right, coming up next on Halftime, more pain for private credit as one big bank moves to limit its exposure to the group. Our Leslie Picker is following all the money for us. Halftime back in 2 minutes. And we are back on Halftime with a market flash. Angelica Peebles joins us now. Angelica.
Hey, Frank. Papa John's has received a bid to take the company private from Qatari-backed Earth Capital Management. That's according to the Wall Street Journal. The Wall Street Journal reporting that the deal would value Papa John's at about $1.5 billion. That stock was up, as you can see, it's up now about 22%. It was halted for a little while. And we have reached out to Papa John's. We don't have comment. We'll be back to you with anything we hear from them, Frank.
Yeah, looking at Papa John's shares spiking right now, up over 20%. This bid, it looks like it follows a bid that came from Apollo last year in November. They actually withdrew that bid, but now more interest for Papa John's. Again, shares up just about 20%. Angelica, thank you very much. All right, when it turns to the financial space, alternative asset manager names, they're under some pressure after reports that JP Morgan was marking down software portfolios and limiting lending to private credit groups. Our Leslie Picker joins us now with much more on that part of the story. Leslie.
Hey, Frank, yeah, this involves leverage that JP Morgan is providing to private credit funds that the asset managers have historically used to juice returns. It's known as back leverage. The collateral for this type of financing is the underlying loans for those private credit funds. A lot of software in there, as you mentioned, and that is what is being slightly marked down, according to two sources close to the situation. I'm told that JP Morgan took this moment, did some additional due diligence across the financing portfolio, name by name, and then they had an overlay of what's going on in the macro environment, what's going on a sector basis, and from there, they determined that the loans were too highly valued. In this environment, a lot of this has to do with the revaluation in software. Now, what does this mean? First, let's be super clear here. This is not JP Morgan clocking a bunch of losses, but rather what they see as a preemptive move. One source described it to me as pumping the brakes versus hitting the wall. There are not an onslaught of margin calls as a result of this. It also does not mean that private credit clients necessarily need to immediately post more collateral, only if they want more leverage. Now, what this does is limit the borrowing capacity for some private credit managers for JP Morgan lines specifically. Now, you can see, as you mentioned, Frank, shares of the major alternative asset managers, they're slumping today and down quite substantially year to date.
All right, our Leslie Picker live in CNBC headquarters with the very latest in the private credit space. Leslie, thank you very much. Jason, I want to come over to you. Here on the desk, you have ownership in the private credit space with Apollo and Blackstone. Yeah. What do you make of this report?
Yeah, so I mean, obviously, this storm has been very difficult so far this year. I mean, essentially all the alt managers are down 30%. I think as it relates to Apollo, for me, I think about their insurance business, Athene, which I think insulates them to a certain degree from all the mess that's going on. I'll also add their retail BDC, as we talk about the software story and what's going on there. They only have 2% exposure, and they've also guided to 20% growth in fee-related earnings. So, it has been a difficult trade so far this year, but I continue to like this one. Blackstone, another one obviously is down 30 so far this year. They deployed over $138 billion in 2025, and I think the realization environment will continue to improve. So I have kind of been patient in staying steady with these names here.
I want to pivot over to financials and with you, Joe, really quick. PIMCO actually blaming what they call sloppy underwriting for some of this private credit reckoning, saying it's not just a crisis of confidence, it's a crisis of really bad underwriting. Does this make you concerned at all about the broader financial space?
Well, first of all, the financials coming into the year as it relates to positioning and sentiment, overwhelmingly you had bullishness, and that bullishness was expressed in overweight positioning. So that's the first thing to understand. The strength right now in financials is in the exchanges, CME, IBKR, and a lot of the insurance companies, Travelers, Chubb. Here's the challenge in front of us. We have right now lending to software companies where we don't have the visibility and the transparency on what price discovery ultimately is for the value of the loans. We have something in front of us that can be very constructive if, in fact, the Federal Reserve actually does their job. The Federal Reserve raising, lowering rates, yeah, we all understand that. But if Steve Leisman's watching, you want the question asked of the Federal Reserve chairman at that meeting during the press conference. What is the communication line right now with Wall Street lenders? Do they have the transparency on the true value of these loans? Can they give the marketplace a degree of comfort that they are on top of the situation? We need the Federal Reserve to get in front of this situation and to let the marketplace know, in fact, where they believe the real valuation on this lending ultimately.
Let me give you a very, very short primer on private credit. Private credit, they raise funds, capital, and then they're forced to put that to work. They're not raising capital for lending and substandard lending in cases, to hold it and pay, whatever, a money market rate on it. So their job is purely raise the capital, put it to work. Now, it's become very competitive finding great credits. So what are they going to do? They're driven by fees. So they want the fees on lending. They don't get fees if you're just in cash management. So that's the whole game. Now, you don't have the same regulatory oversight. So you don't have the same reserve requirements and all that. So it's a shadow lending system that we were all concerned about that really grew exponentially and that we were all concerned about. Now, I wouldn't worry so much about the BlackRocks. I wouldn't worry about the Blackstones. I'd worry about the second and third tier players, because they're the ones that didn't spend on the risk controls and the underwriting management. If I own those like you do, I wouldn't be a seller. I want to buy them because they're cheap, but I don't see any catalyst right now, and maybe not for this next 6 months, a year, depending upon if we go in recession or not, like we did from the oil shock in the 70s, where it just doesn't make sense to load up on these now. I'd rather miss the first 10% up than catch the next 20% down.
Understood. We've got to leave the conversation there. We're going to shift gears right now and turn to our Mackenzie Sagalos with your CNBC News update. Mac.
Hey, Frank. Iran's new leader was reportedly injured in the early hours of the war. The New York Times reports that Mojtaba Khamenei suffered leg injuries, but that he was alert and sheltering in a secure location. In the 3 days since he became Iran's supreme leader, Khamenei has not appeared on video or issued any written statements. Jeffrey Epstein's longtime accountant is meeting with the House Oversight Committee right now for a closed-door deposition. Richard Kahn served as Epstein's accountant for more than a decade, and several of Epstein's victims allege that he helped enable Epstein's crimes by creating a complex financial structure around him. Kahn has consistently denied any wrongdoing and says that he was unaware of Epstein's crimes. And with passengers facing long lines at U.S. airport security, the Department of Homeland Security has restarted the Global Entry program 2 weeks after suspending it because of the partial government shutdown. Global Entry allows pre-approved, low-risk travelers to get expedited clearance through customs. Frank, back to you.
All right, Mackenzie Sagalos with our CNBC News update. Coming up, navigating even more volatility, Christina Partsinevelos has your ETF Edge. Coming up next.
We're back on halftime. I'm Christina Partsinevelos with your ETF Edge. Headline risk has dominated the equity and commodities markets as of late, but in the ETF market, the impact has been a little bit more muted. Joining me now is John Davies, CIO at Astoria Portfolio Advisors. John, I'm going to jump right into the questions. You have the majority of equity markets in oil that are swinging hard every single day on headlines lately. Yet you maintain that ETF investors especially should not lose sight of their own long-term objectives. Why is that?
Well, I think geopolitical risk is something that the market, historically can model out and look at the distribution of outcomes. So, the research shows that, typically markets do get past this point and then do go up over time. I think the bigger concern I have is more about what's going on in the private equity and private credit space, where, if you look at Blackstone, KKR, Blue Owl, some of these stocks are down, 30, 40% in the last 3 months. I don't think that it's systemic at this point. So we're looking at the spread between double Bs versus triple Cs, and that spread is around 750 basis points, which, the range over the last 2 years, let's say, is 900 to 550, somewhere around there. But it's definitely worth keeping an eye on for sure.
So if you're bringing up private credit, and let's say my focus or investors are longer term horizons, are you saying avoid private credit, or are you suggesting any other way to put your money to work right now?
Yeah, I think it's more about looking at, where can you get the best return per unit of risk? And obviously that space is challenged to the point. I think there's plenty of, I think our underlying thesis is that the U.S. economy is still quite strong, and between tax cuts, tariff cuts, rate cuts, there's plenty of opportunities. We just think it's not in the Mag 7 stocks. It's in, the broader, let's say mid-cap space, eco-weight space, and some of these sectors like industrials, energy materials, sectors that, can benefit from an elevated, let's say stagflation environment, which I think is also not a big risk in the marketplace, more so than, geopolitical.
Thank you, John. Short and sweet. And remember, you can all find our content at etfedge.cnbc.com. Frank, back over to you.
Christina, thank you very much. Christina Partsinevelos with today's ETF Edge. Straight ahead, more calls on committee stocks. Halftime's back right after this. And welcome back to halftime. Let's hit some stocks on the move. First up, Eli Lilly getting a price target increase at Wolf. Joe, you own this one in the Joe T ETF. Shares pulling back about 0.5% today.
Stock has been pulling back. If we could, while I speak, pull that chart back to the beginning of the year, you'll see that early in January, that was the high price point for Eli Lilly. I think the market cap now has fallen below $1 trillion. Recently announced capex of $3 billion to expand the supply chain in China. We know about the very strong fundamental tailwinds that exist for this company. But something interesting that I've noticed about Eli Lilly, and I've mentioned this on air now for the better part of the last 18 months, it trades like a biotech, doesn't it, Jason? And biotech, if you look at the XBI, again, you will find the XBI kind of peaked in late January. So right now in the healthcare sector, it's really about names like Vertex, Gilead, Amgen, Abbott Labs. That's where I'm seeing the strongest healthcare momentum.
You know, really quick, they're waiting for approval of their weight loss drug in China. Do you think that's priced into this stock? You mentioned it's slipping below $1 trillion.
I think to a certain extent, maybe it is. I don't have enough confidence on that to say one way or another. I believe it's priced in.
All right. Moving on to the rideshare industry, Uber announcing a strategic partnership with robotaxi company Zoox. Jason, you own Uber.
Listen, it's another example of their foray kind of into the AV business. I mean, this is one of many deals. Zoox is the latest, but Wave, Wabi, Lucid, so it's all about the platform. It's nice to see a little bit of a bump to, almost 3% today. Stock's down about 10%. Gross bookings were up 23% last quarter. Mobility up 20%. I continue to like this stock in the long run.
Taking a look at the chart, it's up about 4.5%, 5% over the last month. Steve, you actually sold out of this name not too long ago. Just your view on this partnership. We talk a lot about these partnerships when it comes to autonomous driving. Is this meaningful to you that it's with Zoox, obviously a subsidiary of Amazon?
What's meaningful to me is that when you partner with somebody for rides, that your margins are a lot lower. You've got to share it with somebody. So that's troubling to me. I don't think the stock should necessarily be up on that because we don't know what the economics are, right?
But wouldn't the autonomous vehicle still be cheaper than the driver? Hypothetically.
Well, you tell me. We don't know. Okay. Drivers pay for the maintenance, they pay for the insurance, they pay for the upkeep of the car, they pay for the car. Okay, if you don't have a driver to do that, who's bearing that cost?
Well, that's a fair point.
Right? So we just don't know the economics.
All right. We're going to move on to something we do know. Micron's price target hiked at Wolf ahead of earnings next week. Joe, you own this one in the Joe T.
So this is a high beta technology play. This is alpha generation on steroids. This is being played on the institutional side, the hedge fund side, and from speculators. You have to understand the characteristics of what this is. It's hyper volatility. In the last 6 months, it's up greater than 175%. You're going to hear next week in the earnings that both earnings and revenue growth is going to be up once again, triple digits. DRAM, dynamic random access memory, it's up expected another 170+% in 2026. So you have to be careful with something like this because of the hyper volatility and understanding that when you begin to see the moderation in DRAM pricing, that is when you're going to see the correction unfold for Micron. What do you do with that? You maintain a position accordingly that incorporates that hyper volatility into the story. Lastly, you do want to hear from them how they're going to be managing the high bandwidth memory relationship that SK Hynix and Samsung has developed recently from NVIDIA. That could be a little bit of a competition challenge for Micron.
All right, let's take a look at Micron shares up just about 4% right now. Coming up next, Mike Santoli joining us with his midday word. We're back right after this. And we are back on halftime. Senior markets commentator and overtime co-anchor Mike Santoli joining us with his midday word. Mike, what are you seeing in this market? We've been talking about it quite a bit here on the show. A lot of volatility, but today relatively muted. The Dow is down 300 points, but still pretty muted.
Yeah, for sure, Frank. I mean, it's still a lot more churn. I mean, I've been saying for over a week that the market is rationally hopeful about maybe that this crisis can remain somewhat contained. It's not going to exit this window of a few weeks where you actually have energy costs. You're going to have to extrapolate this for the rest of the year, et cetera. I think there's a way of looking at the market action today. Even if crude is up a few bucks, it's still within yesterday's range. I know that's not saying much. It was a massive range yesterday, but it's not giving you that much new information if crude is up a few bucks on a given day like this. So the S&P is in wait and see mode. I'm more focused on things like the churning, the rotations inside the market. The big bank index, BKX, that's challenging its 200-day moving average on the downside. That's not that great if you lose the banks in this instance. The S&P is out of the breakdown zone at the lows of a couple of days ago, but we're still only at levels that we were hoping were going to be the floor last week. So it's very much indecisive. I would say that considering the closing of the strait was thought to be the worst case scenario, and oil prices are not yet at super punishing levels, I think you can explain why the S&P is managing to hang in there. Finally, the AI hardware trade reasserting itself is necessary to stay supported. It's not good breath today, but you have enough strength in the big tech names that we're kind of staying in the game at least.
All right, Mike Santoli with his midday word. Mike, we'll see you coming up on OT.
Yep.
Stay with us. Final trades, they are coming up on halftime. And we're back on halftime with final trades. Weiss, you're up first.
I sold FTAI in February. I bought it back as a trade. I'll be at higher levels. I'm going to add.
Jason.
Goldman Sachs are getting caught up in the private credit storm. I like this one here.
Shannon.
Regional banks not getting caught up in the private credit storm, but being pressured downward with the rest of financials. Opportunity with lower rates coming.
Joe.
Lam Research.
There we go. That does it for halftime. The exchange starts right now.
Frank, thank you very much, and welcome to The Exchange. I'm Kelly Evans. Sell the rumor, buy the fact. Take a look at oil prices heading back towards $90 a barrel today, even as the IEA is set to release a record 400 million barrels of oil by its members. We're off those $78 lows from yesterday, and it's putting some pressure on stocks right now, but not too much. You can see the Nasdaq still positive, the S&P down 7, the Dow is the underperformer, down 319. Big piece of that is the financials. Once again, the losers, the staples as well. Financial stocks are off 9% now in the past month, and we'll hear from WaFd CEO Brett Beardall about his concerns about private credit shortly, along with what else has been weighing on the space. The stock of the day is Oracle, rising 10% after earnings, although it was down by half from its highs last autumn into the print. We'll talk about its plans for debt and more. But let's begin with this oil situation after the International Energy Agency announced plans to release a record 400 million barrels of oil from strategic reserves to help ease the global disruption. Unclear the pace of the release and the breakdown of what types of oil, which traders say will be crucial to really understand the move. My next guest says pressure will remain on parts of the energy complex that are more difficult to store. Let's bring in Max Layton, the global head of commodities research at Citi. Max, it's good to see you. And overall, I mean, this is a big move. It's more than double what they did in 2022, if I'm not mistaken. Is there any concern that it would leave the inventory situation shortchanged, or is that just not the worry right now?
Sure, thanks for having me. So around 12 months ago, global oil inventory was around 10 billion barrels. It's gone up 700 million barrels over the last 12 to 18 months or so. So broadly speaking, the world has built something of a buffer. And yes, you would draw down some of that buffer with this 400 million. You draw down roughly half of it. Back 12 months, 18 months ago, oil was trading, Brent was trading $75 to $90 range. And that's kind of where we are at the moment, at the top end of that range. So you can look at this and say, hey, the market's kind of pricing a 4 to 6 week disruption. And I think the IEA and the OECD countries are going to come and fill that gap.
Yeah, they are stepping up in a pretty big way, especially the U.S., Japan, as I understand. What do you mean that there are parts of the energy complex, though, that will still remain under pressure?
Yeah, sure. So I think what we're referring to there is in particular jet fuel. Jet fuel is a standout. So in Europe and in Asia, jet fuel prices are trading around the Russia-Ukraine highs. It's the only part of the product. The world doesn't consume the crude oil. It consumes the products of crude oil, gasoline, diesel, jet fuel, naphtha, that we turn into plastics. And some of those products are hard to store. They degrade over time. And so we just don't have the same inventory that we do in the others. We've got a lot of gasoline inventory. We've got very little jet fuel. And so if there's going to be tension in the product market, it's going to be in jet fuel.
Right, and so much of this still depends on those flows going through the Strait of Hormuz. How would you describe the situation today?
Well, I would say that we're at a point now where the escalation from here would involve on the kind of US and global side potential 1970 style oil shock. So that's energy infrastructure being attacked, Hormuz straight out for months. That's where we could be heading. And on the Iran side, President Trump alluded to further measures that he could take, that he's reluctant to take, that he doesn't want to take, which would, I think, be obviously quite destructive for the Iranian regime and the economy and the country more broadly. And so I think we're at a point where the next level of escalation is so painful for both parties is not the base case. It's not going to happen. So I think once the military campaign finishes, whether that's days or weeks, it's really hard to say. But once that finishes, I do think there is a path to both sides de-escalating and that's the baseline view.
Yeah, and I think you said you and others still have some questions about what the pace of this release will be, and what types of crude specifically. So I'm curious if you can elaborate on those issues.
Of course, yeah. So the IEA did a big study back in 2018, and they claimed that, they said in that study that if the countries, at a maximum, the countries could do an initial flow of up to 24 million barrels a day. So 11 million barrels a day from the public stocks and 13 million barrels a day from the commercial stocks. 24 million barrels, I mean, obviously it's not been tested. This has never been tested in the 30 years or so that they've been building this across the OECD countries that participate in the IEA. But wow, it's possible. It's theoretically possible, but it would have to be something. It's kind of similar to like global central bank coordination. You'd need all the countries to participate. You'd need them to give clear messaging that they're going to provide liquidity and they're going to be there. So far, that hasn't really happened, but I'm expecting that to happen going forward.
And so is that pace for you a pretty swift pace that will do a lot to keep oil prices contained, or is that pace going to be too slow?
I think the early signs are it's not particularly quick, but it could be. And I think that's the important bit, is on paper. So for example, if the US can do a certain run rate of destocking of public inventory, then you add on top of that the European countries, then you add on top of that the Asia-based OECD countries. In total, according to this study, you could do up to 24 million barrels. The market probably only needs around 10.
I see.
It's possible, but they have yet to commit to doing it.
All right. Well, we will all be following those kind of signs of movement with interest. Max, for now, thanks. Appreciate it. Max Layton with Citi. Now, we've had 10-year notes go up for auction after a pretty poor 3-year auction yesterday. So we turn to Rick Santelli for the much more important one. Rick, to see how it went.
Absolutely. Now, this is a reopen. First time it's reopened, adding to an issue that was primaried about a month ago. So it's really a 9-year, 11-month security. And the yield at $39 billion put forth by the Treasury, 4.217. The when issued market was about 4.21. So it tailed about 3/4 of a basis point. So it gets a little bit off for pricing. The grade, C-, better than yesterday's D+. And the reason? Well, the bid to cover was a little light against 10 auction average. The directs were a little light against 10 auction average. And the dealers taking nearly 13%, 10 auction average at 10%. So it just was a little behind the 8 ball in terms of all the metrics. But here's something interesting. Okay, today, should we close here, be the highest yield close since February 6th. But it isn't only us. This is us and Europe, but not Asia. If you look at the UK, they're on pace for the highest yield close in their tenure since October 9th of 25, and the EU since October 19th of 23. So we want to definitely keep an eye on long rates, whether it's partially the conflict, partially debt, or trying to compete against all the AI-generated corporate securities, maybe a little bit of each. Kelly, back to you.
Oh, did you say C+ or C-?
C-. C-.
All right. We need to get those grades up. Rick, thank you. Rick Santelli. Meantime, this comes after the CPI report, which was roughly as expected, but also it's a little backward looking. They now have to reconcile high energy prices over the past week as the Fed prepares to meet next week without the visibility on what that will yet mean for CPI. But some on the street are seeing ways to blunt the impact on consumers, looking at the tax refunds, which are 11% higher or so than last year. Joining us to discuss the current inflation conundrum is Jefferies chief U.S. economist Tom Simons, along with CNBC senior economics reporter Steve Leisman. Welcome to you both. Steve, just kick us off. What do we see in the PPI headline and core? I'm sorry, the CPI. Thank you.
I called it the CPE this morning. It's okay. So they were both relatively well behaved, with some questions as to whether or not we're seeing the true picture, in part because we're getting this housing disinflation. And there's some talk about it being related to the shutdown. So when you get done doing all the things that would have happened because they wanted to put out a post-shutdown inflation report, you might be adding 0.3 to 0.4 on top of it. So it looks still well behaved, even if you add it back, but just not as good as maybe it is. The other problem is that there are components from the CPI that are used in the PCE, those components today caused, I believe, Barclays to double what it thinks is going to happen at PCE.
Jeez.
So what we thought was hopefully a coming together of these two, a kumbaya moment for these two series, they're in fact going further apart, and we're probably going to get a hotter PCE. And all of this is troublesome because we're definitely going into a period where at least the headline number is going to be hotter.
Yes, and Tom, Nancy Lazar was looking back at the 1991 Gulf price shock, and you did see that headline accelerate while the core slowed because at the end of the day, people only have so much money to spend.
Exactly. It ends up being essentially a zero-sum game at the end of the day. And I think that that's actually a big contributor to why we're seeing a difference between the CPI and the PCE deflator as well. If businesses are, for instance, seeing margin pressure because they're having to pay tariffs, or generally still seeing wage pressure from a lack of skilled labor that's available, then they're going to push those prices through to high margin goods or services that are generally sold to consumers who are less price sensitive, so upper income individuals. Because the PCE deflator is a measure of the price changes in what people actually spend money on, it captures some of that fact that it's only limited price increases that are being passed through. When the CPI looks at the big basket of goods and services and kind of looks at what the average person buys, it's a lot of lower, sort of more basic goods that are in there, and they end up not seeing as much price increases since businesses know that there's just really no more, change in the wallet for consumers to accept those price increases.
I think the story here is the math that I'm getting from economists, which is take $20 extra per barrel, and that could add on 0.5, 0.6 to next month or the month after.
Yeah.
And that's okay. What we want to know is, does it bleed into core? And that's the question. Does, and do rising gas prices, rising oil prices, that going to lift things that are not directly related? We know airline fares are going to go up. I think you had a guest on who said that the real crunch point is jet fuel. So you might get a sharper move there. But again, that's okay for the question that we talked about yesterday, which is, can the Fed look through this? If it stays in the headline, it can look through it.
What's in the market right now in terms of any more cuts?
Less, fewer.
One,
that's right.
or...
One. Well, we have the probabilities. We don't have to guess. It's 63% for the first cut, and what's important is that that's not until September.
It's September now for the first cut.
I find this remarkable because this is the way the market is trading, and then no second cut there. And what's interesting is that you are now saying, the market is saying, Warsh is going to come in June. He's going to sit his hands in June. He's got another meeting in July. And then come September, he'll get around to cutting. I'm not sure I believe the way the market is priced, but that's the way the market's priced.
What do you think, Tom?
Yeah, I agree with Steve, actually. I've been having a hard time sort of understanding exactly how the market has come to this conclusion. I wonder if perhaps there is some, kind of cross signals, I guess, in thinking about how energy is going to affect the stance of global central banks. So, for instance, the ECB and the Bank of England, they don't have as much flexibility to cut because they are exclusively focused on price stability and inflation, right? And the Fed, with a dual mandate, in an economy where people generally need to drive to work and, stuff is generally shipped on trucks that are driven with gasoline engines, all this stuff depends on energy, and thus, there is a big risk to growth if energy prices remain quite high. So I also agree with Steve there that it's hard for me to see how Kevin Warsh would have sold himself to President Trump on his ability to deliver lower rates and then not really do anything on that front in the first couple of meetings. Perhaps the market is trying to price in some possibility that Kevin Warsh is not confirmed by the June meeting. Senator Tillis has said, in the past that he doesn't want to move forward with that until the DOJ pulls or completes their probe against the Fed, that's ongoing. So I'm not sure, but I still think that there will be a cut could be even as soon as April, but definitely by June. And I would think at least 2 for this year, and 3 is probably more likely than 1.
Wow. So I think it's important, Kelly, to point out, I wonder what Tom thinks of this. Look through means different things to different people. Some people say look through and cut. Other folks say look through and don't hike as a response. If I were to measure it exactly now, I think the center of the committee is in the latter. Look through, that means we're not going to hike. There are some on the committee, Myron, maybe even Chris Waller, that say we can look through this and cut.
Right.
I don't think that's where the center of the committee is.
Even after the negative payroll number?
Well,
minus 92.
Okay, so tell me what the payroll number is, and I'll tell you what the Fed is not cutting against, right? So if we're losing 25, 50,000 jobs a month, the Fed is cutting.
You think? Okay.
But if you're still in this plus 30 range, this anemic job growth number, and you have this headline inflation problem and concern that it bleeds into core, then I think it's going to be an extended pause.
Maybe I'd put it this way, Tom, as a final word, is the market is at one cut, and you might get there if we have positive payroll prints the rest of the year, but and maybe not. But if we remain negative, do you think then we're looking at 2 or even 3 still?
Oh, yeah, definitely. I'm not expecting that we're necessarily going to see a series of negative payroll prints that continue on from February. There are a number of things that kind of drag that number down that look like they're idiosyncratic issues that should resolve in the month ahead. I do think that what's going to happen here is that there has to be a perspective on what's gone on in the energy complex and an understanding of how long this is going to last. We're not talking about a dramatic shift in the supply of oil on a durable basis. I don't think that this is an analogous situation to what happened with Russia, where with the invasion of Ukraine, that there was a concern that you're going to lose, whatever the daily production from Russia is per day on an ongoing basis. There's a lot of oil that's currently sitting in the Persian Gulf that right now kind of has a negative value, and it's really, wants to get out of the Straits of Hormuz and sold onto the market. So when that comes, there might be a slight delay in when it kind of translates into lower gasoline prices because of the refinery delay processing, but eventually there has to be an expectation that whatever price increases we're seeing from energy are going to reverse, and we're going to get a big drop down in inflation at some point later in the year.
All right, Tom, thank you. Appreciate it today. Thanks for joining us. Tom Simons and Steve Leisman, thank you, of course, as well. We got some breaking news out of Washington. Eamon Javers at the White House. Eamon, what's happening?
Hey there, Kelly. This comes from the U.S. International Development Finance Corporation. They've just announced over the past couple of minutes that they have found a partner for that reinsurance program that the U.S. government has been working on to ensure oil coming out of the Strait of Hormuz. The U.S. International Development Finance Corporation saying that Chubb will serve as the lead partner for the DFC's $20 billion maritime reinsurance plan that's designed, they say, to resume commercial shipping in the Gulf. They're saying here in the press release that DFC and Chubb have also identified several American insurance companies to provide reinsurance policies behind Chubb and alongside DFC to expand market capacity. They say additional reinsurance partners may be announced in the coming days. There's a quote here from the CEO of Chubb, Evan Greenberg. He says, in part, the commerce passing through the Strait of Hormuz plays a vital role in the global economy, and providing vessels with insurance protection is essential for resuming trade flows. So that coming from Evan Greenberg, the chairman and CEO of Chubb, according to the DFC press release. Guys, back over to you.
Shares almost kind of ticked briefly into the green there, still down just fractionally as they, investors have to weigh what this means for the company. But of course, the administration throwing everything it can to try to get the situation moving. Eamon, thanks. Appreciate it. Eamon Javers. Coming up, the bank stocks are on track for their first 3-week losing streak since October. We'll speak with WaFd CEO Brent Beardall about why that is and some of his concerns next. Plus, Oracle says it's not planning to raise more debt this year. We'll get one investor's reaction to that coming up, with the shares off session highs, but still up a healthy 8%. We're back with much more on The Exchange.
This is The Exchange on CNBC.
Welcome back. Another sign of problems in the world of private credit. JP Morgan is now marking down the value of private credit loans it holds as collateral and reducing its general borrowing capacity there. Shares of private asset managers are lower again today, with Ares down about 4%. A little off that right now, but still on pace for its worst day in more than 3 weeks. The big banks are lower as well by 1-2%, fractionally now, a little bit off the lows. My next guest says there is some reason for concern here. Let's bring in Brent Beardall. He's the CEO of WaFd Bank. Welcome to you. And tell you were at the RBC Financial Services Conference yesterday. Was there a lot of talk about private credit?
There was a lot of talk about private credit. And the reality is, in the whole banking sector, we talk about cycles. There's credit cycles. And it's really been 15 years since we've seen a credit cycle. And a number of the investors I was talking with said, literally, I haven't lived through a credit cycle. And if you think about what's happened with banking, we have kept our balance sheet so pristine, but private credit has kind of taken up, okay, we'll make the riskier loans. So it makes all the sense in the world to say, okay, if we're going to start having another credit cycles, where do you see that come through? And that's private credit, and that's what's happening now.
I like the way you put that in. Many think this is a reckoning moment for the industry, maybe an overdue one. The only general concern, I mean, other than if you're an investor in the space, is there going to be broader fallout? You know, do we have to worry that because of kind of panic in one area over here, that it's going to spread throughout the financial system?
Yeah, I don't think so at all. I think it's normal. If you're in the business of lending money, you're going to take losses. That's just reality, and we plan for it. And I think the banks are in really good shape. The question is, what was the underwriting on those private credit? Where did they go? And the irony I find here is banks said, okay, we're not going to make these loans, gave the opportunity to private credit. Then banks turn around and they loan money to private credit, and they call it business loans.
That's exactly right. Yeah. So is that an issue?
It is an issue for some. Certain banks, for WaFd, for example, we said we're not going to do that. We find that a little bit, counterintuitive. Why would you not make the loans yourself, then lend it to somebody else who's going to make the loans? But as we know, there is always it's a river of demand, and if you don't meet that demand somewhere, you'll meet it somewhere else.
So you think it's going to be kind of contained? Like, yes, there are going to be losses. Yes, the industry may adjust in size, but it's not something that So do you think financial stocks here present an opportunity? And, if you think maybe the economy does okay, I don't know what you're seeing in terms of loan growth.
Yeah, I think financials present actually a huge opportunity. You look at our stock, for example, we're sitting here trading literally at tangible book value.
Wow, are you?
Even after the nice run we've had, we have a wonderful chart that shows the growth in book value per share. And I can't control exactly what happens on the stock price, but I can control growing book value per share. And we've done a nice job of continuing to grow book value per share. So today, the biggest opportunity we have is to buy our shares back and increase the slice of the pie for our existing shareholders.
Is that frustrating, though? I mean, do you want to put that money to work in other ways?
Oh, it's very frustrating. Of course, we want to put that away, or not put it away, put it out, get it out there in loans. But when you're seeing the competition make loans that are sometimes irrational, the most important thing you can do as a banker, and it's so difficult, is to have discipline. Know when to say, hey, I'll pull back and not grow, or hey, this is a good time to grow. And with what we've seen with private credit, we've said, okay, let's pull back a little bit, let them make those loans that we might think are a little bit too risky, and then we'll see what happens there, and then eventually we'll come back to us.
Yeah, it's a good point, though, about you want to make your loans at the right price, maybe not what some others are doing. Meanwhile, there's this whole new, tell me about X Money. Okay. This is a product that Elon Musk has introduced, which is sort of taking off, as I understand. And you think this is something the industry really needs to be watching closely?
I know very little bit about it, like everyone else does. It's just being announced. I think they have it out in beta. But I think of Elon, and whatever you think about him politically, he's the genius of our time. And what he did to the automobile industry and to the big three automakers with Tesla, I think he's going to do the same thing in banking with X Money.
Well, you better hope he doesn't. I mean, that doesn't bode very well if you're sitting on the other side of it.
But we're not going to take it the same way that the automakers did, right? We have to, the winner will be the consumer. X Money is going to offer a 6% interest rate on deposits.
Jeez.
That is a loss leader. You can't make money, right, with the Fed paying 4%, you can't make money at 6%. So he's willing, the richest man in the world is willing to pay an additional 2% to take market share.
But that's not, how do you compete with that?
Well, you don't compete with it just based on rate. If you're just going to compete based on rate, you don't compete, right? But what we offer, especially as regional banks, is relationships. So you have to have great technology. It's going to make us better. So you pair great technology with relationships. That's where I think we're going to be able to compete. But they are going to take amounts of market share from the biggest banks that I don't think we've ever seen in our lifetime.
I'm glad you kind of put this on the radar. And finally, there's this whole question about stablecoins, which the Bank Policy Institute is not in favor of, kind of allowing them to offer yield. Or the bill, I think it was the Clarity Act that's currently held up, would allow this to be enshrined in the financial system. What's your point of view on this?
My perspective is the world moves, and we have tokens, and we have crypto, and we have Bitcoin, and we have stablecoin. All of these things, it's wonderful, and if it can make payments faster, more reliable, we should do that. But if you want to pay interest on stablecoin deposits, fantastic. Do it within banking. Apply for a bank charter, work within the same rules and regulations, because everyone says stablecoin, well, there's no risk in that. I don't believe that at all. There is risk in that, and there will be fraud that occurs in there. Then I believe what's likely to happen, if stablecoins grow and then there's a failure, where will they come? When there's a failure, they will come to the FDIC fund.
Yeah.
So the banks will end up having to bail it out anyhow. So stablecoin, welcome them paying interest. Become a bank, pay interest on those deposits, and follow all the laws and regulations we have to. Let's compete together for the betterment of our consumers.
It's a good point about going to the FDIC, which you guys are funding. Saying,
That's right.
Hey, help us out. Brent, you can walk us through everything. And thanks so much for making the time.
Thank you for the opportunity.
Appreciate it today. Brent Beardall with WaFd Bank. Coming up, why the boom and bust days of memory stocks may be behind us, and what it all means for investors. Look at these year-to-date gains still. We'll be right back. Welcome back to the exchange, and markets right now are still kind of what do we call this, processing, trying to process what's going on in the oil complex, aren't we all? The Nasdaq's still up 0.1%. The Dow is down 0.5% or 258. And Campbell's is moving lower after posting weaker than expected results and slashing its full year forecast. They now expect EPS of just $2.15 to $2.25 a share. Previous guidance was $2.40 to $2.55. As a result, the shares are having their worst day since July of 23. They're down 5%. They are now trading at their lowest level in nearly 23 years. And it's a different story for the memory stocks. After a downturn during the recent volatility, they're back on a tear, picking up where they left off and adding to their massive yearly gains. SanDisk, Western Digital, SK Hynix, Micron, Seagate, we're talking 4-fold to 12-fold gains in just 12 months. If you're waiting it out, thinking I'll buy these names on the dip, well, let's see how long you're going to wait. Christina Partsenevelis is here to explain. And the reports of industry were raising prices 100% every time you turn around, these crazy numbers to back up the action we're seeing.
Which maybe speaks to the sustainability of this upcycle in the memory market. And so for decades, and I bring that up because memory stocks are a trader's game. Boom, bust, repeat. But I spoke with many executives across the industry, and the message seems to be very consistent. This cycle is different. HPE CEO recently just told me, quote, "We will continue to raise prices because the industry will continue to raise prices. There is just not enough supply for demand." He's speaking about memory. SK Hynix also told me that AI workloads require a fundamentally different and far more memory-intensive architecture than anything the industry was built to support. The quote you're seeing on your screen really speaks to customers just willing to sign on for long-term agreements, and specifically on the demand side, Micron as well. Micron management told me customers are now more than willing to sign long-term supply agreements locking in memory for years. Marvell's CEO, a perfect example, said on their earnings call they locked in supply all the way through 2028. Of course, you got hyperscalers crowding out consumer supply and no meaningful relief coming until 2027 at the earliest. Memory stocks, to Kelly's point, have absolutely surged. Micron up more than 350% just in the year. SanDisk over 1,000% during that same time frame. What memory management is now asking investors to believe is that this time is different, that AI has structurally broken the old boom-bust cycle, and with long-term contracts replacing spot market deals and hyperscalers locking in supply for years, they maybe have a case. But to your point, you saw the stocks go down just last week, so others are saying this is just a meme trade,
I doubt the cycle. I doubt it's not going to be cyclical. I just think that the upside right now is so great. This just is going to go on for so long. When it turns, maybe it'll turn a few times within that before it falls apart. But at some point, there will be, there will be the other side of this. But this current upcycle might last and last and last.
But then you're making the statement that at some point everything will come down. It's not just memory. We're talking GPUs, CPUs, all of the optical connectors for all of these products, the build out of the data centers, the power needed.
It's probably true. Yeah.
Right?
I mean, at some point, this is the gold rush, and it may go on for some time, right? But it's up to the companies, I guess, to try to figure out do they worry about calling the top or not? If I were them, right now it's just guns blazing, like full speed ahead.
Yeah,
so.
None of these CEOs. However, Marvell's CEO did say on the earnings call that he does expect a moderation for CapEx, and he's the only CEO that I've actually heard say that out loud. But not memory supply. That is just being locked in for years to come.
First we'll have to see them not doubling prices in a month, and then that'll be the first sign.
To your point, $900 laptop is supposed to go up 40% because of these memory prices, according to TrendForce.
Oh, another thing for the
consumer. All our electronics.
Hang on to that one right there.
Yeah,
stickers and all.
Stickers.
Christina, thanks. Let's get to Mackenzie Sagalos now for the CNBC News Update. Hi, Mackenzie.
Hey, Kelly. President Trump has put his disarmament plans in Gaza on hold, Reuters says, citing 3 sources with knowledge of those negotiations. Reuters reports that Trump's attention has turned to the Iran war, which has ensnared multiple countries that pledged money to help rebuild Gaza. The White House denied the Reuters report, writing in a statement, quote, "Discussions on disarmament are ongoing and positive." The British government released documents today showing Prime Minister Keir Starmer was warned of general reputational risk around Peter Mandelson's relationship with Jeffrey Epstein before appointing him to the U.S. ambassadorship. Starmer fired Mandelson in September after emails released to the public showed his relationship with Epstein. And lava erupting from Hawaii's Kilauea volcano reached more than 1,000 feet yesterday, prompting temporary closures of roads and a national park. It marked the 43rd episode since the eruption on the state's Big Island began in December of 2024. Luckily, the molten rock was confined within Klaue's crater and didn't threaten any homes or buildings. Back to you, Cal.
Look at that. Wow. Mackenzie, thank you very much. Coming up, is Oracle safe now? It seems like Wall Street got some of the answers it wanted from their earnings last night and no new plans to raise debt this year. Wedbush's Dan Ives saying the core AI and cloud numbers and backlog tell a robust AI revolution demand story. The shares are up almost 9% right now. We'll dig more into it next. One for the good guys, a clearer path ahead, and delivers on acceleration. Those are just some of the positive commentary on the street today after Oracle's big beat. The company reported double-digit growth in both total cloud revenue and cloud infrastructure. The shares were up at the highs 13% today. My next guest has held on to the stock throughout its recent weakness and calls the beat a big relief to the overall market. Sarat Sethi is managing partner at DCLA and a CNBC contributor. So, Sarat, why did you stick with it? Welcome.
So, we bought it when the multiple was in the low teens. When you had all the announcements went up to the 40s, we sold a piece of it, kept kind of the remaining. But I still think cloud is the core for Oracle. And what the issues that they faced were in the credit markets. Really, that was how much debt is a company like that going to take on? And I think, Kelly, the reason that I'm relieved is because they said a couple of things. One is obviously the cloud growth is high in the 40s, but more importantly, the credit markets, the spreads kind of came down because they're not going to the markets to borrow any money, and that's where the market's going to look for in the future to say, hey, you're spending all this capex, it's going to be self-funding, we're not going to the credit markets, and we're going to have our customers now bring our own chips. So I think you got a relief rally out of that. Because if it had been the other side, I think it would have brought down a lot more other than just Oracle.
Yeah, that's what I was going to ask. Kind of talk about what you think the ecosystem here is that now can be breathing a sigh of relief.
So I think you get the NVIDIA's breathing a sigh of relief. I think you get the CoreWeaves, and then you get the other, the chat GPTs as well, who are using all this as a sigh of relief because what that would have said was, hey, wait a second, the demand's not there. And Kelly, you were just talking about, memory stocks. It would have brought that whole sector down, because the question would have been is demand still there? And then are we double ordering? And then, it's sell first, ask questions later.
Do you think there's double ordering going on there?
I think there's so much demand that right now, yes, I would say the Fab 7, everybody is trying to get their orders in, and that's also comes from the chip sector for your telephone. So I think that's all going to happen too, and at some point those two are going to have to meet, and the question is, what's the price point?
We're about to talk about, I'm gonna give away our mystery chart if I ask you this, but I can't resist. You still like a couple of SaaS stocks. We were talking about Workday. I don't know if that's one of them. Intuit, Salesforce. How are you thinking about the software space? What do you have exposure to here?
So all three of those, actually. So Intuit, Workday, and Salesforce, and then we also own a couple like Roper. Look, I think it's 11 to 12 times cash flow. These are very cheap stocks. Salesforce said they're going to buy back $50 billion. Workday's got their new but old CEO back, and I think these are tough businesses for Vibe Coding to take out. So they'll have to prove that they can execute, and especially a company like Intuit that has such a big moat around its business, right? I mean, you look at the information that all of these three companies have, it's going to be very hard to replicate the security issues, the integrated issues. So it's going to be an execution story, similar to what Oracle had to do today.
Yeah.
And I think you'll get some of that multiple back, because the earnings are going to be there. They're going to grow high single digits to low, 10, 11%. That does not deserve a 12 times multiple. It's something higher than that.
You mentioned Vibe Coding, and a friend of mine who's one of the best kind of like computer scientist programmer types out there. His firm says to him, you got to do more with these AI tools. And he kind of laughs. But, are there any more implications of the fact that that Vibe Coding is taking off to such an extent?
So I look at it two ways. One is, yes, you can do that, but then you're sitting there in an isolated space, and what's to say that information that everybody wants is secure, right? The second part that I don't think is appreciated as much is we just don't see that Workday, Salesforce, Intuit, Roper, all these companies are sitting still. They're using all this information, all this technology to improve themselves. And they've got the resources and not just the people, but the billions of dollars behind them in cash flow. They're not going out to capital markets to say, hey, we need venture money. So I think that's where you have to kind of give them the benefit of the doubt and say, hey, they've done this before. I know some of them might lose, but if you go with the best of them, I think you're going to do well down in the future.
And if you don't have the stomach for it, you can do the high-quality compounders, you say, like Visa, MasterCard, and Thermo Fisher. Sarat, we'll leave it there for now. Talk again soon, I hope. Thanks so much. Sarat Sethi from DCLA. Coming up, Oracle's not taking on any more debt, but another software peer is Salesforce. See, we're going to reveal, because I just talked about it. Deirdre Bosa says it feels less like confidence they're playing here and more like defense. We'll talk about that right after this. Welcome back. And Moody's downgrading Salesforce as the company reportedly plans to sell up to $25 billion to fund stock buybacks. Deirdre Bosa has more in today's Tech Check. This is the theme. WaFd's doing it. Salesforce is doing it. People who think their stock is undervalued, Deirdre.
Yes, but what they're doing and how they're doing it is a little, I mean, it varies, but basically levering up, taking on debt to buy back stock. That is the playbook specifically of IBM and old Oracle, not a company exactly that's pioneering a new AI software age. Now, on paper, you can see the logic. They just beat earnings, revenue north of $40 billion, free cash flow nearly $15 billion. Investors spent years telling Benioff to stop acquiring, start returning capital, so he is. But here's what also stands out. Agentforce, their AI play, it's growing at 170% year over year, but it is still less than 2% of revenue. The stock is flat this month, while ServiceNow, Datadog, Shopify, they've all bounced back from this sort of severe software sell-off. So the market is picking winners in that sell-off, and CRM just isn't one of them yet. Now, there's another detail here, Kelly, that doesn't get enough attention. Salesforce pays about $3.5 billion a year in stock comp. So a big piece of any buyback isn't returning capital, it's just covering dilution. The bet here is that AI disruption fears they're overblown, and if Mark Benioff is right, that looks smart. This all looks smart. If he's wrong, though, he just tripled the debt on a company whose growth story the market is already questioning. And to your point, Kelly, yes, we're seeing more tech companies borrow more, but they're putting it in most cases to M&A or to build infrastructure for this AI trade. This is purely to buy back its own company. Begs the question, do they have something better to spend it on?
Right, tripling the debt load. Yeah, it is a big move. It is a big. And who was it? The Trade Desk CEO the other day who bought a bunch of stock. Workday, they brought back the old CEO. I mean, I do watch this and say, these people are putting their money where their mouth is. They are. It's not like they're saying, hey, it's going to be fine, and turning around and offloading the shares.
Yeah, and I think that's correct. It is a signal of confidence, but in this case in particular, they're borrowing to buy back their own stock. Other companies borrow to execute a growth playbook. So I think that's the difference we're looking at here. Yes, this is going to be a confident move, but could it be spending that money better somewhere elsewhere?
Yeah, absolutely. Deirdre, thanks. Appreciate it for now. Deirdre Bosa. Coming up, higher oil prices getting a lot of the attention lately, but nat gas higher as well. That could all mean a pricier grocery bill right around the holidays. Fertilizer costs are up. We'll explain all of it right after the break.
Everything from oil to diamonds being held up in the Strait of Hormuz, including a key component of fertilizer called urea. Prices as a result are near 4-year highs as the Middle East produces between 40 and 50% of the world's urea exports, most of which pass through the strait. That has fertilizer names like CF Industries and Intrepid Potash surging. CF is up nearly 18% since last Monday. Not only is CF North America's largest urea producer, but comparatively lower nat gas prices here could give them a competitive edge over Gulf-based competitors when it comes to producing other fertilizer components like nitrogen and ammonia. Let's bring in Joel Jackson. He covers the chemical and fertilizer space at BMO. Joel, it's great to see you. And these stocks, I mean, if you own them and the conflict quells, do you think they still have significant upside?
They do. I'm sure on the day the war ends, hopefully they would fall back a bit. But I think what we're seeing, if there's weeks of outages here, we've seen a week and a half, weeks of problems, the issues are going to linger for months, right? You've got lots of problems going. You mentioned some of them. You have just gas prices going up, gas being cut in Qatar. Countries like India, which make a lot of nitrogen now, are cutting gas to their own nitrogen production plants. So a lot of things that are happening that could make 3 weeks of war last for 3 months of 3 months of lingering effects. So I think you could rest on the fact that prices will stay higher for longer and these names could still outperform.
And how many times have we seen squeezes like this on these prices? What does it usually mean in terms of the effect on food in the grocery store?
In 2022, in the initial months of the Ukraine-Russia conflict, we definitely saw prices go up a lot for a year. They came down eventually. You never really saw the large impact on food prices. Like fertilizer prices, they go up a little bit or a lot. They don't really impact food prices as much as you would think. So there's not that large impact downstream on crop prices. And that's why crop prices really haven't moved yet in the last week and a half.
And could that change? Or because we're hearing people talk about, hey, consumers, watch out around the holiday season, and I don't know if that's just alarmist language or if there's some, basis to it.
No, of course it could change. If we get into months of problems in the Strait of Hormuz and other things going on and the whole global supply chain of commodities changes and energy prices are higher, then for sure it could change. But right now it just hasn't.
Yeah, you're watching nitrogen, phosphates, potash, methanol. I mean, there's a lot of different kind of inputs here to the global supply chain. How would you kind of describe them in terms of importance and where are we seeing the biggest impacts?
Well, half of the world's fertilizer is nitrogen. And as you said in your preamble, I mean, a large chunk of that is coming out of the Middle East and Russia for exports. And so, you can't just replace that. And so you could see a dramatic change in half the fertilizer costs very quickly. And then, of course, natural gas is a large input to a lot of fertilizer. So, I mean, methanol is more niche, potash and phosphate a little bit smaller, and potash and phosphate aren't as affected. Yes, they've got some production in the Middle East. Yes, phosphate does use sulfur and ammonia, so that's also nitrogen, but they're just not as directly impacted, not as materially impacted. It's really nitrogen where you could see the most impact and the quickest.
And you also cover companies like Deere. What does this mean for them ultimately?
Well, we've had a bad couple of years. I mean, the stock price has done great for Deere and CNH and AGCO, the ag equipment players. But we've really seen farmers not buy new tractors and combines for a number of years. Farmer economics haven't been great. If we're in a situation where crop prices are only up a little bit, but fertilizer and other input costs are up a lot, it's going to make it hard to transition from kind of the contraction we've seen in ag equipment in large North American ag, tractors and combines. We're going to, it's going to see hard to transition now to farmers wanting to spend the large capital purchases again. This could prolong the contraction like another year.
Wow, because I remember, wasn't it Deere who had that big pop on earnings just a month or so ago?
They had an investor day in New York that was great, and they really laid out a really strong, midterm EPS guide of $40, $50, $60 EPS for a company that will earn less than 20 this year. So they're pointing to some really good, performance that they can deliver over the next 3, 4, 5 years. That really got investors excited.
Right, but I take your point that overall, actually, you think this could be a tougher go for them because they're facing, and farmers might be facing rising input costs, but not. So in a weird way, the farmers want crop prices to go up, even though the rest of us might not.
Right. Well, I mean, we were still facing the transition this year from contraction, hopefully stabilization and growth back in large North American ag, tractors and combines. If this prolongs it another year, those targets might seem harder to achieve.
Yeah, exactly. Joel, we appreciate it. Thanks. And by the way, your base case scenario now is that what for the actual activity that is passing through the strait?
I mean, look, last week, everybody thought the war was going to end in a matter of days, maybe weeks. Now it feels like it could be weeks, maybe months. It's just sort of the consensus view. So my base case is still, I guess, that this will be over within weeks and the effects prolong for months. But honestly, it seems so fluid every day. Who knows?
Yeah, no, I think it feels that same way to a lot of us, and yet the market, kind of taking it in stride for now. Joel, really appreciate it. Joel Jackson joining us from BMO. We'll have much more on rising fertilizer and energy costs coming up on Power Lunch with Interior Secretary Doug Burgum. He's going to join us next hour. That does it for us here on The Exchange, and I'll join Brian Sullivan on the other side of this quick break.
A bit of a mixed bag for stocks, even as oil ticks back higher. Welcome to Power Lunch, everybody. She's Kelly. I am Brian. Stocks mostly lower right now. Financials, one of the decliners down over 1%. Oil also on the move. The Paris-based IEA saying 400 million barrels of oil will be released to help curb the Strait of Hormuz supply disruption. And we have got a big guest in a few minutes. We are joined by Interior Secretary Doug Burgum.
And the stakes are high for more than just oil. Shipping of retail and other goods is also at a standstill as the Mideast conflict continues. Iran reportedly struck 3 cargo ships in the Strait of Hormuz. We'll speak to the chief executive of one of the biggest shipping insurance brokers in the world. That's coming up this hour. But we start with the markets as the major averages are moving lower and the war in Iran continues. Our next guest is out with a new note saying the historic move in oil prices warrants a re-evaluation of the risks, and he's updating his strategies as a result. Joining us is Venu Krishna. He's the head of U.S. equity strategy at Barclays Investment Bank. And good luck, Venu, to anyone. Our last guest was looking at this more from the ag space, but he said, yeah, I thought it'd be days or weeks. Now I'm thinking weeks or months. What are you thinking?
Yeah, I think this situation we are in, it looks like it's probably got more life. It's not going to get resolved as quickly as the market is expecting. But interestingly, the market is still, as of now, pricing as if we are looking through it, then there will be an imminent resolution to that. But that said, I think it does call for us to look at just the historical precedents and to see if this were to get extended, how do you position? And like you noted in our recent work, we are recommending more tilt towards value, which historically has tended to do better. And at this point in time, if I look at the composition of the value basket, not only is it meaningfully cheaper over the longer term versus where the growth basket is. At the same time, if you look at the composition, they are more exposed to commodity-oriented areas, which obviously tend to get bid up in an environment in which geopolitical risk is higher.
But
so I
for
think
instance,
that's one way to think about it.
So, you say value positive, growth neutral, and yet we've almost seen the opposite kind of stock performance where we've seen, the Mag 7 kind of cushion the market. Tech has been leading the way. Software has been on a comeback. Whereas materials, it's going to be a tougher story. Consumer staples, we've seen some sputtering there.
Sure. So I think to connect to your point, from the beginning of the year, the areas we have really liked are threefold. One is tech, especially big tech. The second is financials, and the third was utilities. So we haven't changed that. So, and you are right in saying that, big tech, we have a very interesting situation where, because of the reason why we like it even more. So since the last 2 quarters, their earnings have continued to beat expectations by a reasonable margin, and yet their multiples have been moderating on a steady basis. As recently as a couple of days ago, they were trading big tech as a group, which is just essentially 6 stocks, at about 24 times forward earnings. They were at 31 times at the start of last year. So I think we like the setup in which their earnings revisions are going up. Their multiples are coming down, and the profitability is actually expanded even further in Q4 by about roughly 150 basis points. The one overhang is that they continue to spend quite aggressively, with their spend this year up, more than 60%, and next year it moderates, but the spending levels are very high. So I think that is what is the key issue. But we think in terms of where you would rather stay in a market like this, in which geopolitical risk going up, we would still feel very comfortable in big tech.
Small cap companies are greater exposure to oil and gas prices than larger cap because they rely on the American consumer to buy their goods and services. Gasoline prices are 50 cents a gallon higher than they were 1 year ago, Vinu, and probably going up. Will that kill or hurt the small cap story?
Actually, it's interesting you bring that up because we actually turned more negative on small caps after having changed our outlook a few months ago. For a long time, we were negative on small caps, and we changed our view recently, but we flipped again. To your point, once geopolitical risk goes up, oil going up is one piece of it, but it does affect consumer sentiment. These companies are a lot more levered. They have less operating flexibility, a lower margin profile. And the critical thing is fundamentally, if you look at the revisions, compared to large cap revision trends, which are, by the way, are excellent right now, small caps don't look that good. So
what does that mean? Large cap revision trends are excellent. We like the E word. We like to hear excellent. What does that mean?
It means that if you look at where we started the year, what was the expectation on a consensus basis for earnings? For example, it was roughly around $307 by consensus. Right now, we're sitting at close to, call it in the 317 range. That's a pretty sharp increase. If you look at realized earnings for large caps, it was close to 12%. On sales growth of a little over 7%. So very strong operating leverage. In other words, the numbers compared to even 3 months ago are going up to the right. And that is not necessarily what we are seeing in small caps.
All right. Vinu, thanks so much for joining us. And again, it's a good luck to anyone. Do you have a thought now for how long this could last? Days, weeks, months, years?
No. I mean, to be honest, I'd be foolish if I were to claim I know it. I think nobody knows. But we do know that the longer this persists, the more problematic it is in terms of the impact on global energy markets, on global economies, eventually on GDP. And you're looking at the impact on inflation expectations, and hence the move in 10-year rates, which definitely is worrisome. We're not in that range right now, but once you breach 4.5% on the 10s, watch out.
Right, we're around 420 or higher even now. So 4.5, you say, watch out. Vinu, thanks so much for joining us. Good to see you. Vinu Krishna from Barclays today.
Thank you.
All right, well, speaking of interest rates, we got some breaking news from your tax money with the release of the big monthly Treasury statement. Let's find out what is in it. Steve Leisman is here with that and those headlines. Steve.
Hey, Brian, some interesting headlines here. The February deficit, that's just the month, was up 2% over 1 year ago, up $7 billion. But fiscal year to date, doing a little better, down 12% to $1.004 trillion to be precise. And the issue there is that Treasury outlays were up by 2%, but receipts were up more by 6%. And this is stuff that's going to change. Right now, we're watching this issue of individual receipts were up 5%, but corporates were down 49%. But here's what's going to change is these custom duties, well, we don't know if they are. They had a good month, up $27 billion, up $19 billion from a year ago before the tariffs were put on. And fiscal year to date, they were up by $151 billion, or up to $151 billion by $131 billion. We don't know how much of that goes away. We don't know how much is coming in refunds. Speaking of refunds, this was supposed to be a big refund year and getting some mixed results here. Individual refunds coming in at $64 billion. That's up just $6 billion from a year ago. But looking at the year over year, or the fiscal year to date numbers, it's 104 versus 103. So we're not quite yet seeing those big refunds. There was a report from Citi yesterday which used March data. This data ends in February, guys, saying it was running about $33 billion, which was about a third of the big expectations out there. So we're going to have to watch this, Brian. What's happening with these refunds? Obviously, there's going to be tariff refunds, also going to be individual tax refunds that are supposed to be robust this year and help propel spending, but not quite in the data just yet.
Not quite in the data just yet. Do we know when we might get that? I mean, listen, 1 month, as you have said many times, does not a trend make. When can we establish some kind of longer term or medium term trends?
So February is supposed to be a really good month for these, and they are running about 10% higher, which is a good number. I just talked to Robert Frank, who is our expert in all this stuff, and he told me that a lot of the refunds go to rich people. Rich people take their time, so maybe the bigger refunds are yet to come. So we're just gonna have to monitor this, and it's supposed to be a big part of why retail is supposed to do good or do well the first part of this year, and we're watching these daily numbers, in fact, to see how well they're doing.
Get a refund, buy a couch. Steve Leisman.
Couch.
Thank you.
Pull out sofa?
Maybe, depends on the price. All right, now to the bond market's yields. They are pushing higher again today. The 10-year yield on pace for its highest close since February 6th. This, folks, a sign markets are repricing the path for rates and inflation. It is also impacting the rate you pay if you want to buy a house. 30-year mortgage rate hitting 6.19% today. That is the highest level since early February. And Kelly, as we just heard Venu Krishna say, if and when, if the 10-year gets back to 4.5%, things may go sideways.
Bigger pressure point, for sure. Yep.
All right, speaking of big, we've got a big interview coming up for you. Interior Secretary Doug Burgum will join us live as Iran tells the world to get ready for $200 a barrel oil. But is that just a hollow threat? Bank of America's head of commodities will join us on the other side of the break. And then the Interior Secretary, a lot to do. We're back right after this.
Welcome back. Oil, other commodities also squarely in focus as the shipping standoff around the Strait of Hormuz enters its second week. We've got WTI crude at 5.5 to 88. You've got fertilizer, nat gas, and even drinking water, all impacted by a lack of ships coming and going. Some have tried, and today the UK Maritime Authority says 3 freighters were hit with some kind of attacks in the area. Meantime, the IEA saying it'll have its 32 member countries release 400 million barrels of oil to ease supply issues. That's more than twice as much as was released from those stockpiles when Russia invaded Ukraine. It comes as Iran is trying to hit America in the wallet and warning of $200 oil. What does Francisco Blanch think? He's BofA Securities Head of Commodities and Derivatives Research. Francisco, it's good to see you. Are we going back up to 119, or we're kind of, going to look back on that and say, yeah, no, that was just a one-off thing?
Well, I really think it depends on the duration of this conflict. We are looking at, in our baseline scenario, we are looking at Brent averaging $77.5 for the year, which would imply prices likely peak sometime this quarter, next quarter, averaging, so this month, next month, averaging about $85, $90 a barrel. But that's only if the conflict ends shortly. I think if we are looking at a prolonged conflict where it spills into the second quarter, prices will be meaningfully higher. We think that we could see highs of $130 a barrel if we spill into a second quarter. If we spill into the third quarter, we think the highs could be 160, 170. And of course, if we start carving into the fourth quarter, we could be over $200 a barrel. But that would require a pretty extended conflict here, in our view.
Right. I mean, we're hoping it doesn't do anything like. Does it make sense to you, Francisco, the market action, the price of oil, stocks here?
I think oil's reacting with the view that this war is going to last days, if not maybe a couple more weeks, and that kind of makes sense to me. The deficits that we estimate for this quarter, barrels from Hormuz, but it only goes on for again, it's only our numbers only work if this lasts for days, not months, right? So there's a clear time limit as to how much the market can take, and there's a risk that it goes up exponentially if somehow the conflict extends itself into in time. That's I think very, very important. So market's confidence is going to end up soon, and that's kind of what President Trump has been guiding everyone to think, I think.
Oil may be the least important major commodity going through the Strait of Hormuz. I mean, fertilizer, you want to eat over wanting to drive, and fertilizer, 30 to 50%, different types of chemicals going through, potable drinking water, natural gas, which goes into even things like pharmaceuticals, all going through that strait, Francisco. But you got to admit, sort of to Kelly's point, this is remarkable. I want to kind of just highlight to our audience, we have the greatest supply disruption in oil since the early 1970s, since sort of the Suez crisis and war, and yet the price of oil, while higher than it was a while ago, is still the same price it was 2 years ago, 3 years ago, and lower than it was 4 years ago. Even you, Francisco, have got to admit, that is remarkable.
It is remarkable. There's no question about it. But I also think that a lot of it is because the market still prices in a pretty short duration of this conflict. Remember, the U.S. today is a net energy exporter. There is, of course, the potential response from U.S. shale. There is strategic stocks. China itself has built a massive strategic petroleum reserve. So there's a number of buffers. But as I said, if it goes on in time, this is 20% of the world's supplies we're looking at here for oil and gas. It will impact all markets. In fact, it's already impacting markets. We are seeing factories in different parts of the world slowing down and shutting off temporarily because of a lack of feedstock for petrochemicals, for instance. And again, if you look at the Russia-Ukraine war, it kind of started a little bit like this. It just went on forever, and we ended up with essentially $600 a barrel global gas, or $99 NMBTU global gas. So again, a lot of it's the duration. We started in February. The war started in February, and Putin invaded Ukraine. Gas didn't peak until September. So it took 6 months for that. So let's just keep that in mind.
Yeah.
It really is about the duration of the conflict.
Fair enough. And you know, to quote the great poet philosopher Mike Tyson, he said, everybody has a plan until you get punched in the face. And we're talking about a 2-week war, 3-week war, and we'll talk about this a little more with Secretary of Interior Doug Burgum in a moment.
But yet, Iran is going to have a say in all of this. We don't know anything about the new supreme leader, the Ayatollah Khomeini's son. We don't know anything about who's actually running the country. And we do know that, like today, some ships were hit with drones. Thankfully, I hope everybody was okay. Oman may or may not be partly on fire. What if this does go on for 5 months? Then what?
Well, if this goes on for 5 months, as I mentioned, we are going to have a massive energy supply shortfall, and therefore the mother of all demand rationing exercises. Energy and GDP are closely interlinked. So 1% energy is about 1% GDP. If we lose, let's say, Hormuz, we are talking about 20% of world's oil supplies and 20% of LNG. Put it all together, you're probably losing roughly about 10-15% of aggregate energy supplies. So unless we can reroute, we are probably going to lose several percentage points of global GDP. That's the reality of this war if it goes on for 6-12 months. Now, I'm not sure that the Iranians have the ability to do that. I think we've heard messages from the Trump administration saying they are confident they're going to reopen the strait, but also we saw what happened with the Houthis in Yemen and how bad that went with Bab el-Mandeb and the Red Sea. So those are some of the big concerns we all have as to the duration of this war. We don't know, as you said.
Yeah, we don't.
I think we haven't even heard the voice of the new Iran leader.
No.
Many people haven't heard his voice, right?
He wasn't even at his own installation rally, apparently.
I heard he was injured on the first day of the attacks, fractured a foot or something to that extent.
It doesn't sound like people think too highly of Khomeini Jr., but we'll see. Francisco Blanche, Bank of America Securities. Francisco, thank you. All right, so though oil gets all the headlines, just remember this. That 21-mile wide shipping strait, which I've actually seen and been in person, is a critical choke point for many other major commodities and refined products. One of those is fertilizers. Now, fertilizers, this is not, what your horse used to produce. These are chemical pellets. They're about the size of a small gumball or a large BB. And about 1/3 to 1/2 of some of these chemicals head through the Strait of Hormuz. So that puts a spotlight on American fertilizer producers like CF Industries, Mosaic, and Nutrien. They're up 7%, and 3% right now in Nutrien at a 52-week high. Just remember, we're talking about food.
But interestingly enough, as our last analyst just told us, this is not yet showing up in crop prices. So the squeeze is actually on some of the farmers, some of the deer, those kinds of companies. We don't want it to pass along to food prices, don't get me wrong. He said it's been contained so far, but all of this goes back, as Francisco said, to the duration of the conflict. Coming up, Interior Secretary Doug Burgum. He'll join the show to talk the Iran war, energy prices, and the IEA's decision to release those 400 million barrels. Stay tuned. He's after the break.